G'day folks, it's James here from Onchain. I want to introduce a Twitter Spaces that I was invited to the other week, which I thoroughly enjoyed. It was a fairly lengthy discussion. We went for about 3 hours, but the topic was all about Bitcoin basics. And the audience was supposed to be, people who were just hearing about Bitcoin, maybe not necessarily for the first time, but really from a very ground level, right? What is Bitcoin? What does it mean philosophically? How does it fit into the world? What is mining? What's the difference between mining and a node? So it's not very often I get to come out of the analysis weeds and really explore Bitcoin from a very ground up perspective. But I really enjoyed the conversation. I really hope you do too. If you've got any questions or comments, leave it in the section below. And otherwise, I'll let you get to it. Cheers.
I'll kick it off with the very basic question of how do you describe what Bitcoin is, stuff like the code, the network, the people involved with it, even the philosophy, the miners, which you've just touched on, if you want to go for that, mate.
Oh yeah. How long have you got? So Bitcoin, I mean, at the end of the day, what is it? It's a piece of open source software. That's pretty much what it is. And the interesting thing about this piece of software is that everybody who runs it, their little computer, whether it's a Raspberry Pi or a laptop or a server, whatever it is, they start to speak to each other in the same way that Tor or people who've downloaded, torrents, BitTorrent, same kind of thing. It's all these computers that are just talking to each other. Now, what they do is they send a whole series of messages, but essentially what they're doing is they're communicating on a truth. And what the software does is it tracks, it's a database, and it's a database where it's an append only database. And every 10 minutes, a new row of transactions gets added to it in a block. Now, what happens is that those transactions is basically it's a history. It shows who owned what and when. And there is an incentive for all of the users of that network to not change the rules. Now, I like to equate the rules of Bitcoin to the rules of chess. They change over time in the case of chess over centuries, and they change globally. But it's very, very hard to get somebody to play a game of chess with you start with three queens. Not many people are going to play that game because it's not very fair. And we've kind of agreed on the moves. We've agreed on the setup of the board. Yes, sometimes new moves, right, castling or any of these other things get added, but it takes the whole world to go, you know what, that as actually is a better set of rules. So there is an incentive for people to run this code because it maintains the history of their history, right? The coins that they owned. And there's also an incentive for everybody to keep the same rules because there's a 21 million hard cap in this world where there's an infinite amount of money, there's an infinite amount of stocks, there's an infinite amount of bonds. And in many instances, there's too many of these things. Bitcoin is one of the few assets where there's only 21 million. It's a very fixed number. The other way I like to think about it, there's 21 million points in the world, and everyone's trying to get their hand on as many of those points as they can. And the reason why is because they know that there's going to be no more of them. So there's that and scarcity is a very human trait. We all like to collect stuff. It's why gold became, sound money for 5,000 years or so. It's because it's really hard to get your hands on it. And when you do get your hands on it, you're going to be able to trade it for somebody else somewhere in the world. Now, in Bitcoin's very short 15-year history, right? It's one of the newest assets ever. It is one of the few assets, probably the US dollar, gold, and Bitcoin, probably the only two assets in the world you could get an exchange rate in every fiat currency on earth. It's a pretty remarkable achievement in 15 years. So there is something about this scarcity thing, and there's something about this common set of rules that everybody agrees on. So we've got this append-only ledger. It's a piece of software that anybody can review. It's essentially the most secure piece of software ever written because, it's worth $1.4 trillion now. And you've got every hacker in the world. And there's some pretty hardcore hackers out there. Some of them work for governments. Some of them hack into governments. Every single one of them has a $1.4 trillion bounty out there for 15 years to try and break this thing. No one's done it. So it is the most secure piece of software ever written. It's amazing that it is just open source software, and yet it manages. I mean, I've said this before. It's the most loved, hated, feared, and revered asset of all time because you've got people who will dedicate. I mean, like myself, I dedicated my career to it. right? I used to be a civil engineer. I could have done all sorts of stuff, but Bitcoin was by far the most fascinating thing I ever found. So, there's people who just are so into this thing. And then there's some people who have no idea what it is and they hate it. They hate it with everything they've got. They hate it with, like, I don't know where it comes from, but they absolutely loathe this thing. And when you ask them even the most basic questions about it, they couldn't even come within, 15 miles of the answer. So it's this very, very interesting. I mean, this is why it gets so philosophical, because it's different. It's not like anything else. And there's a whole lot of other crypto projects out there, and they're not like Bitcoin. And the market has gone through ups and downs and lefts and sideways and all this stuff. And at the end of the day, Bitcoin has been unchallenged for 15 years. And this is despite all these other coins trying 50 different other things, and they scale better and they smell better and they have better perfume, but they just don't come anywhere close to Bitcoin, right? None of these things have even remotely come close to flipping it. So there is this kind of intrinsic scarcity thing that just really plays on the human mind. There's the security element of the thing. It just, like, it's reliable. It doesn't break. It hasn't broken. They've tried to break it. We can't break it. My friend Michael Dunworth has this great line that he used at the Bitcoin Alive conference last year, not this year, last year. And he said, "We as a society do not have the technology on planet Earth to stop this thing." And he's not wrong. You would have to go and you would literally have to physically go and find every single hardware, every single hard drive this thing is installed on. I mean, I'm sitting here at my desk at my house. I've got a tiny little computer, right, sitting there with a hard drive that's running Bitcoin right in front of me, right? There's many people like me, and they're all over the place. Some guys in Romania, some guys in Nigeria, some guys in Melbourne. Like, what are you going to do? Go and get all of these hard drives? What if I turn it off and stick it under my bed? You're going to find it? Like, and as long as all one computer or two computers get turned back on and they start speaking to each other, Bitcoin just keeps ticking along, right? So this is this unkillable nature of this thing, and I think that's what makes it so interesting, because you can't kill it, because it's scarce, because it's going to be around in the future. It makes it a very, very desirable asset, right? It's a collector's item. It starts as a collector's item, but slowly but surely it moves up the ranks to becoming more than a collector's item. It becomes money, and it becomes it's a desired, or some people call it a Veblen good. The more expensive it gets, the more people want it. So it's a very, very interesting dynamic. We haven't even touched on the mining side, but I might just pause there and see if there's any kind of next steps. But mining is a whole topic to itself.
Yeah, I was actually trying to, or hoping to head in the direction of, how coins are created, what a block is, maybe a little bit about the mining process. You've touched on the fact that it's a network of computers that can be on an extreme scale of, massive server farms and GPUs or ASICs or whatever it is these days. I'm not a guru on that. And it can be, as you said, you at home. I don't mind. I feel like I should, or at least run a node. So I'm curious to unpack mining and nodes. I think the everyday Joe can probably get in on a node, and I think that's helpful.
For sure. Yeah. So really, there's two pieces of hardware that operate within the Bitcoin network. There's nodes, and then there's miners. Now, a node is literally it can run on a Raspberry Pi, it can run on a tiny little computer, it can run on your laptop, right? It's very low overhead software, and you basically need 5 gig worth of drive space, and that's it, right? So that just kind of ticks away. And what the node does that's the software that speaks to each other, right? And what it's doing is it's got this big ledger or a database. It's an append only database, and all the nodes have whatever the last status is, right? They've got all of the transactions, and transactions come in these blocks every 10 minutes.
Mate, sorry, can you just clarify that append only? What's the meaning or term?
Sure. So if you imagine an Excel spreadsheet, once an entry is put in that Excel spreadsheet in a row, so every single row is a timestamp, right? And in that row, there's all of the transactions that happen. So just think about like a packet of data, and that's I sent coins to you, you sent coins to Moonsoul, Moonsoul sent coins to John. You've got all these coins moving around, and basically every 10 minutes, that row in the spreadsheet and everything above it becomes read only. It cannot be changed. You cannot go back and change it. You can't update it. You can't fix it. It's a read only above that line. Below that line is all the transactions that sit in a thing called the mempool. It's like a big cloud of unconfirmed transactions. Now, that cloud of transactions are all people saying, hey, I want to send my coins from here to here, and I'm going to pay this transaction fee to do it. Now, the miners, it is their job. They're a different piece of hardware. So you've got all these nodes that are keeping tabs of all that cloud of transactions and the current status of the read only spreadsheet. That's what all the nodes are doing. And the reason why you can't change it, by the way, why it's read only, let's say I'm a sneaky bugger and I go, you know what? I'm just going to give myself an extra 50 Bitcoin. Well, James's node is going to go, well, I don't think so, mate, because I'm going to agree with John. I'm going to agree with Moonsoul without us touching it. They're just going to say, this guy is trying to put two queens on his board. Kick him out. We don't want to hear about this. Get rid of him. So that's essentially what the nodes do. The nodes have the read only spreadsheet and they keep track of all the other transactions floating around out there in the sky. What the miners do, they're the ones when you hear in the media where they've got these big server farms, and they are. Some of them are pretty ginormous, but some of them are also some guy in his basement with a couple of rigs ticking over. What miners do now, this is probably the most. It is one of the more abstract components of Bitcoin. But the same way that gold miners, why is gold special as a metal? First and foremost, atomically, there's not much of it. And second of all, there's only two ways to get it. You either have to buy it off somebody who already has it, or you've got to go and dig it out of the ground. Now, what does digging it out of the ground require? A whole lot of work. Quite literally, you got to have diesel trucks, you got to have rock breakers, you got to have pile drivers, you got to have shotcrete, you got to have engineers, you got to have a whole lot of stuff, right? To get that, it is a physical 10-year long just to spin up the mine project. What mining does in the Bitcoin sense, they essentially solve a puzzle. It's not a hard puzzle, but they solve it trillions of times, just over and over and over. I'm going to get the numbers somewhat wrong here, so don't quote me on this, but the hash rate is currently about 600 exahash. Now, what that actually means is all 8 billion people, you are solving a puzzle. I think it's like 60 billion or 60 trillion times. So you're solving a puzzle in your head 60 trillion times, and every single one of us is doing that every second, nonstop, on repeat. That's what these machines are doing. Now, these machines, the reason why they're doing this is because if you want to go and build the next block, you have to prove that you mined the gold out of the ground, that you did the work. And the reason why that's really important is because, as we know with the fiat system, the central banks don't have to do any work. We've got to work for our money. We've got to go to whatever your job is and do your 9 to 5 and, work your ass off and you get your paycheck at the end of the month. They just change the number in the spreadsheet and they just give themselves more money, right? Which is kind of a bit of a shitty situation. That's why we get inflation, all those things, but we'll get to that. The whole point of Bitcoin is that if you want to earn those coins, you've got to build the mine. You've got to dig them out of the ground, and everyone else is fighting to do this as well. And because they're really scarce, people will, if let's say there's a briefcase worth of money, right? $1,000. How much are you willing to bid to get that briefcase worth of money? Well, the most rational answer for that question is some guy's going to bid 500, someone else will bid 600. And finally, that briefcase will probably sell for $999.99 because someone's going to get 1 cent of profit out of it. That's pretty much all that's left. Miners do the same thing. They will burn enough power and they will consume enough hardware and they'll do whatever they have to do to buy the briefcase, which is the coins that are coming out of the network, right? And that's a predefined supply curve, but that's a different thing. So what miners' job is to do is actually to keep the network hard and secure. And that energy, even nation states, we've seen in recent years actually that nation states can't print energy. Energy is the ultimate currency of the universe because, E equals MC squared, matter and energy are the one and the same. Human beings can't just wish energy out of anywhere. You've got to go and collect it. It's everywhere, by the way. Energy is not a scarce thing. It's just our problem is it's generated in places we can't ship that energy, right? Iceland has more energy than they know what to do with all their geothermal vents, but you can't run cables from Iceland to Australia. It just doesn't work. It's not how physics kind of works with power. So energy is everywhere, but it's actually also very, very difficult to obtain, right? So it's one of these very interesting things where Bitcoin, at the end of the day, what do miners do? They consume energy, which is the ultimate scarcest currency of the universe, which is ironically everywhere, but also not. and they turn that into mining coins. But they will also burn enough energy and time and power and all that stuff that they have to sell those coins. And this is actually a really important point. The miners that collect those new coins, they generally speaking have to sell all of them just to stay in business, which is kind of what you want because those coins have to get distributed into the network. And then it requires people to buy those coins, right? And this is the whole component. It's like this: everybody gets the coins that they've earned. It's that none of this is like there's no freebies. Nobody got given coins at the start of the day. Nobody started with an unfair amount. Everybody had to do something as part of their Bitcoin journey to earn their coins. And I think that's a really important part. The miners had to do it. Satoshi had to do it. We had to do it. Everybody's got to do their own kind of mining to acquire some share of that 21 million points. So I'll leave it there. But yeah, mining is one of the more abstract components of Bitcoin, but it is also one of the most fascinating.
Could you just touch on the difficulty adjustment as energy and hash rate goes up and down? Um,
Yes.
Finish off
So
on the thing.
yeah, so the difficulty adjustment is one of the most elegant and funnily enough, Bitcoin is actually a collection of things. It's a collection of, proof of work, which is the mining thing that actually existed for emails, right? For spam prevention before Bitcoin. All of the different pieces of the puzzle for Bitcoin actually existed. And what Satoshi's brilliance was actually putting them all together. Now, there was one missing piece that many of the, I mean, digital currency have been tried to be designed for decades, right? Cryptographers have been talking about this stuff for a long time. But what did Satoshi do that actually put the whole thing together? He put all the pieces in the same place, but then he introduced this just absolutely beautiful thing called the difficulty adjustment. Now, this is a very simple protocol that basically means the more miners are looking for Bitcoin, the harder it is to find. And if you imagine gold miners, right, they have a feasibility study. They establish a mine knowing that gold's going to be somewhere between $1,800 and $2,200. So within that kind of context, we can get to this much gold. Here's our feasibility. Cool, let's go. If gold goes to $10,000 tomorrow, there's a whole lot of gold seams that suddenly are feasible. There's a whole lot of mines that are previously just paperwork and designs, which are now, oh, actually, get the shovels. We're going, right? $10,000 gold, we can actually go and mine this profitably now. So the more that the price of gold goes up and down, the more people are going to look for it. Bitcoin, price goes up, more miners come online. Bitcoin says, there's more miners. Blocks are coming in faster than 10 minutes. So every 2 weeks, it goes, right, that was a bit faster than 10 minutes. I'm going to actually make it harder to find. Now, the puzzle that these guys are trying to find is a needle in a haystack. The needle is the size of a needle. The haystack is the size of the universe. That's kind of the level of numbers that it's big number stuff. It's amazing. It basically says, "Oh, right, you guys are finding it in about, 9.5 minutes. I'm gonna make the universe much bigger," right? And then it keeps making the universe bigger until it takes about 10 minutes, and it measures again over the next 2 weeks, and it watches, "Okay, right, 10 minutes, good. That universe is the right size. Oh, they're finding it a bit slower. That must mean some of those miners went bankrupt. I know what I'll do. I'll make the universe a little bit smaller, a bit easier for you." So what it does, it expands and changes the size of the universe. The needle's always the same size, but it changes how big the universe is. So at some point, these guys, on average, the machines will find a block. They will find the next block within that 10-minute window. That's what the difficulty adjustment does. And strangely enough, that not only does it allow us to predict what the supply will look like. I mean, I've got a chart on my website that shows you what the supply will be in year 2140 because we know we can estimate it. We know what it's going to be because the difficulty adjustment will make that the case. But it's also actually the key that unlocked and brought all of the other components together, right? So it is kind of it is Satoshi's stamp. He put all the pieces there, but the difficulty adjustment was his primary thing that kind of brought the whole system together.
Would you call it a little piece de resistance or the cherry on top?
Yeah, absolutely. That's pretty much how I describe it. Really, it's very elegant. Such a simple system, but it is kind of what makes Bitcoin so special.
Well, if you want to go for a minute or two, just really quickly on Satoshi, I don't know whether we should touch on the cypherpunks. That gets a bit deep, and there's all sorts of rabbit holes around Satoshi and the code and all that. But
Yes, I mean,
um,
I mean, I think, and actually, I was at a dinner when we were in Mexico, and There's a bunch of Bitcoiners there, and the question was asked, what's the most interesting or special thing about Bitcoin? And a lot of people are like, oh, the 21 million hard cap, or the difficulty adjustment, or this, that, and the other. And my best mate, who's it was at that time was relatively early in getting into his kind of Bitcoin phase, he actually had the correct answer in my opinion, which is Satoshi left. And if you kind of think about what that means, I mean, this dude, whoever it was a very special person, because in order to just like walk away and let it go is, I mean,
Can I
in many,
can
yep,
I chime in here really quickly? The most recent Sailor interview on the What Bitcoin Did channel on YouTube, which I recommend, guys. Checkmate's been on there a few times. Those guys are good. Sailor's most recent statement on Satoshi was Satoshi created a way, and then Satoshi gave it away, and then Satoshi went away. And I just think it's a nice little play on words. It's cute.
yeah,
Good.
exactly. And like the challenge with, I mean, literally, quite literally, every single other crypto asset is that you've got the founder is still there, right? I mean, I think Dogecoin's the only one where the founder actually like walked away, and that's because he hates it. But Bitcoin, it's very special because Satoshi just let it go and he let it do its thing, and there was no head to chop off. Right? We can still see that the number two coin, Ethereum, still has the head honcho walking around, and the challenge is that the project can't really get away from the leadership there. Right? They're trying, but they can't because it's yeah. Anyway, it's a whole different topic. But the fact that Satoshi just walked away is actually what makes Bitcoin very, very special. And you can't replicate that. That's the thing. It was a 0 to 1 moment. Once you've got one, two to 10 is kind of less exciting because you've like, wow, I've gone from 0 to 1. I've got this whole new thing. It's a whole new thing. Everything else is a copy of that thing, but this is the original thing. And of course, Bitcoin has its flaws. It's got its faults, but it's good enough in just the right amount of ways, and has been strong enough for just the right amount of time, and it's survived long enough for just as long as it needs to, and it had all of the right conditions for it to just happen to be good enough to do its job as the soundest money that we've ever found, right? So it really is quite extraordinary. And I think, a lot of people kind of, there's a level of prey to Satoshi elementism, but by my part, I think it takes a very, very special person to put this all together. And it takes another special person to just walk away and let it do its thing without coming back to interfere. And, I mean, I would I have to assume that he has to have died. I can't imagine a human mind can withstand the ability of like not having any say from that point on. Otherwise, they've brilliantly blended into the crowd, right? And they've just come back as a nim somewhere else, or maybe they've gone and done they're just living on a beach somewhere. Who knows? But it takes a serious level of resolve to just take hands off and walk away. And really, there's very, very few examples of that anywhere in human history.
I think if anyone, not to categorize or label, but if anyone would be capable of that crazy sort of resolve, probably pretty likely that they could be Japanese. I just want to touch on something quickly because you touched, or I'm touching on Japan. The early days before exchanges actually existed and all of that, trading sort of stuff that is obviously hugely prevalent now. Are you very familiar with how Bitcoin, like how people bought it in the really early days, other than mining it for themselves, which was obviously the original intention? Because I've heard some pretty wild stories of just people sending money to these random bank accounts in Japan, and all of a sudden they get this email with a strange link in it, and they acquired it somehow. And I don't really understand that. That's well before my time.
That's how Mount Gox used to operate, which was strangely enough, Mount Gox stands for Magic the Gathering Exchange. It was designed to trade trading cards, I think, right? Magic the Gathering cards. And they kind of inherited it became the biggest Bitcoin exchange in the world. And people had to literally mail money to an exchange in Japan, right? That was a part of it. Now, again, it was before my time as well, but and even before that, some other bloke bought. I mean, people talk about Laszlo, who spent 10,000 Bitcoin on two pizzas. Some bloke sold two pizzas for 10,000 Bitcoin, right? Good for him. And a lot of people like, how could you do that? Do you feel bad? Like, This guy was mining Bitcoin with GPUs. He invented the GPU algorithm. He's fine. He had many 10,000 Bitcoin. Don't worry about him. He's fine. So there's a whole lot of these like different sagas and stories, and Bitcoin's gone through so many different phases of evolution, right? Mt. Gox collapsed. It had like 95% of all trade volume. When Mt. Gox collapsed, people honestly thought it was dead. And strangely enough, Bitcoin has died many times. There's actually a website called Bitcoin Obituaries, which has all of the media articles from way, way back, 2012 and 2013 and 2015, calling out Bitcoin as dead. And the strange thing is, it just keeps coming back, and it comes back having shed its skin of all of the nasty people who tend to wrap themselves around it, and which is a line that Travis Kling used recently, which I think was brilliant. Bitcoin does just seem to rebirth itself with a new set of characters and a new, it's unchanged more or less. It's kind of the same thing, but the narratives and the stories and the reason why we all hang around continues to evolve over time, which is again, it's a fascinating study of humanity, not more than just an asset. It's actually a study of us, which is personally what I find really fascinating about it.
Yeah, that almost touches on the volatility of Bitcoin. Maybe people carry on about how volatile it is, but Bitcoin's pretty hard and pretty fixed, and becoming more and more stable over the years, especially with hash rate. From what I understand, it's just slowly building, or maybe not so slowly at the moment. Is this volatility? Are we measuring Bitcoin, or are you measuring other things, or as you maybe just touched on, damn near the whole bloody world, because the world's pretty weird at the moment.
Yeah, it's a very good point. So there's a couple of things there. Let's start with the most factual, and then we can get into a bit more philosophical. Bitcoin is volatile. However, right now in a bull market, it is a third of the volatility that it was in 2017 and half the volatility it was in 2021. So it is becoming less volatile over time. The other thing to note is stocks get more volatile during sell offs and they go non volatile during uptrends. Commodities do the opposite. Commodities are highly volatile during bull markets, and they lose volatility during bear markets when you've got too much supply and all the speculators go away and blah, blah, blah. Bitcoin trades in the commodity category. And this is, I mean, we didn't know what it was for a long time, but it trades much more like a commodity does, where it's actually volatile to the upside. So everybody that you hear saying, oh, Bitcoin's too volatile, it's too volatile when it's going from $200 to $20,000, or it's going from $2,000 to 60,000. That's when it's volatile. When it goes from 60,000 back down to 15,000, it's actually relatively historically low volatility, right? But comparatively speaking. So ironically enough, every time someone says that it's too volatile, I mean, that's because they've been holding it in a bear market, right? Flip your script. It's actually, you actually want to hold it when it's the most volatile, because that's when it's trading the highest, because that's how commodities work. And in a very strange way, the reason why the stock market is non-volatile during an uptrend is because it's the most manipulated shit of all time, right? If anything goes wrong, people panic. The algorithms are designed to go up only. And what happens is when the market sells off, right? The Fed comes in, the central banks come in, they print a bunch of money and they patch everything up and they push it back higher. It's all kind of fake. So this is where we get a bit closer to the philosophical angle. When Bitcoin sells off, right, you actually get a reduction in the volatility. People actually start to leave the market. You get lower speculation, all these kind of things. But in many ways, when you say volatile, relative to what? Because if Bitcoin, I mean, there's periods of time where Bitcoin trades sideways, but in the Argentine peso, it's mooning. And you're like, well, what's going on here? For example, we hit an all-time high in the Australian dollar before we hit an all-time high in the US dollar. And you have to look at that and go, well, why is that? And then you realize it's because the Australian dollar it's lost more value than the US dollar. So the question is always relative to what? And I've got a chart on my website, which looks at the Australian house price priced in Bitcoin. So here's a fun fact that you may not know. In the last 4 years versus the Australian dollar, you can buy 75% less house since 2020, right? So 75%, you're getting close to, you've lost half you can buy half a house at what you previously could. but you're actually 30%. Houses have fallen 36% versus Bitcoin during that time. So everything in the world is a relative game. And I discovered this for the first time when I entered this market back in 2018, because suddenly I've got this thing called Bitcoin, and it's priced in these weird numbers like zero. I was buying shit coins, and they're all like 0.000256, and I'm trying to get my head around like, what the hell is this thing? I've never done currency exchange in my life, right? Only when you've gone overseas, you exchange a couple of $100, you get some weird funny money from the different countries, and it's a novelty of travel. You don't give it too much thought. But when you actually start realizing that everything is relative, and that currencies are just a trading pair or an asset, right? The pound is different to the Australian dollar. They have different fundamentals, and the Bank of England prints a certain amount, and the Australian government prints a certain amount of these dollars, and they trade relative to each other, right? Maybe the economy goes into recession. There's all these different things, but ultimately, humanity is kind of volatile. Does it make sense for our equity markets to just like straight line up? No, of course it doesn't. It makes no sense. It's manipulated. It's fake. It's not real. And the problem is, it's so not real that when the man behind the curtain gets exposed, they have to print a shitload of money to patch it back up, because you gotta give people money to stop looking at the guy, right? He doesn't know what he's doing. He's pulling all the levers, but they need to basically pay people to stop looking. That's kind of what's going on. But Bitcoin is in many ways a reflection of the volatility of humanity. We are volatile. We do all sorts of stupid shit. I mean, look around. It's mad season. So in a way, Bitcoin's volatility is much more normal than people actually give it credit for. And I think one last point on volatility, because it's one that a lot of people miss, and it kind of relates to the first topic, about it being volatile to the upside. You don't go from zero to global reserve asset without a little bit of volatility. Right? Things have got to get shake and bake around. That's just the way that the world works. Um, Apple was volatile, and whilst I'm not going to compare Bitcoin to a tech stock, I mean, strangely enough, gold was volatile when they let it loose back in the 70s, and they removed all the pegs of fiat currencies. And so, what actually happened is gold ripped up to where it wanted to go. It always had gravity that it wanted to go higher, because all the fiat currencies are shit. They're just worthless. They're literally worthless. So when they finally took the peg off, it wasn't gold that went up. It was everything else that went down. It was fiat currencies finding their correct price, which was substantially lower. And I forget, I think it's Voltaire, but there's one of these quotes like, over the long term, paper money returns to its intrinsic value. Zero, right? That's what happens. Fiat money has no real long term value. But they can print it for free, and they do print it for free. And this is the kind of nature of the beast. Did gold rise, or did fiat currencies return to their natural value closer to zero? Personally, I think it's the other way around. I think they head towards zero, and I think Bitcoin is just repricing the world. And that's kind of the way you can think about this stuff.
Do you think Fiat's got any bloody chance of lasting? Like, it just seems like such a circus. I mean, we're just being led down the garden path as far as I can tell.
Yeah, so I think there's two answers to this question. It depends where you live, right? So the Argentine peso has a much shorter lifespan left in it than the US dollar. The Australian Pacific peso has a much shorter lifespan than the American dollar as well. Right, the American dollar has a whole lot more longevity than all these other currencies for a whole host of reasons, being the global reserve currency. People don't know this, but the Great British Pound is the oldest currency in the world. Right, it's the one that's been going for the longest. Bitcoin is now bigger than it. A lot of people don't know this, but Bitcoin is now larger than the British pound, which is kind of a wild thing to wrap your head around, being the oldest currency in the world. But um, fiat currencies will last for a long time, and there's a couple of reasons for this. Governments are not going to give up that special privilege for a very, very long time, right? If you had a money printing machine, I wouldn't give it up either, right? I'd be hanging on to that for as long as I can. And they're going to try and combat that the way they always do, because in order to get out of the debt situation that we're in, first things first, they don't plan to pay back the debt. That's never been the plan. It never was the plan. The plan is to make it smaller. And the way that they make it smaller, right? If you imagine that you buy a house, you've locked in $1 million worth of debt, but suddenly everybody's wages go up 2x. Well, you've still got that locked in $1 million worth of debt. So,
Just quickly, we're talking smaller in percentage terms, not raw terms, aren't we?
in what sense?
Well, people are still going to have a whole lot of debt, and governments are still going to have a whole lot
Oh,
of debt.
yeah.
They
No,
grow if they grow their GDP, then the percentages blow out in
correct. So,
their
so what
favor.
they're trying to do is make the GDP bigger. Exactly. So your debt to GDP, they want to make the GDP number bigger so the debt too is smaller relative to it. And the way they do that is via inflation. And there's basically two ways that a government can pay off their debts. They can go out via two methods, fire and ice. Going out by ice basically means, all right, everybody, we're going to go very austere. We're going to tighten our belts. There will be no more healthcare. There'll be no more public education. There'll be no more pensions. There'll be no more roads. I mean, seriously, how long is that going to last? It'll last about the next election cycle at most, because people will vote that guy out. They'll put some other guy in who will bring all those policies right back in. So, first things first, no government is capable of going out via ICE because the people will not allow them to happen. So, what that means, they have to go out by fire, which means that they will print the money and inflate the money supply, make the GDP bigger so the debt gets smaller. Now, that's not going to be a fair situation either, because the reason that we're in this kind of wealth divide problem that we have is that not all people are close to that money printing machine. Politicians are much closer to it, right? Bankers are even closer. There's a whole lot of people who are close to the source of the money. It's what we call the Cantillon effect. And unfortunately, the poorest people in society, they're the furthest away from the money. And it's just the hard reality of the world. They're the furthest away. So they're actually the people who have to wear the inflation the most because their wages are the lowest. The maximum amount of their paycheck gets consumed by that inflation. If you're, middle and upper class, you've got assets, you've got a house, you've got gold, Bitcoin stocks. These are all things that people basically get out of dollars and escape the inflation. And Bitcoin just happens to be I mean, what's good about Bitcoin is that it's available for everyone. Again, it's open source software, anybody can run it. Yes, you've got to buy it off somebody, but everyone's got to buy it off somebody. It's called proof of work. There's 21 million points, and you're not getting any for free, just like everybody else. Everyone's got to work for them. But it's one of the best mathematically, just like factually, based on its performance. It's one of the best tools that's ever existed for everybody. The guy in Nigeria, the guy in Turkey, us here in Australia, everybody can access this thing because there is a fiat currency trading pair for Bitcoin in every country. So it's very, very fair. Everybody can just protect themselves to whatever extent they want to or can. Everybody can buy the same percentage of their life in Bitcoin to just protect themselves from this inflation. So it is one of those very special assets in that regard. Um, but yeah, I mean, they have to go out by fire. They have no choice, and we've crossed event horizons all over the place. So, getting back to the original question, fiat currencies will be around for a long time, but they sure as hell won't be worth as much as what you're paying for them today. So, they will be around, but they won't be worth much.
Um, thank you, sir. It's a nice little segue actually into. I've got a bit of a list of points, and that was literally the next one. Um, I assume you, checkmate, and I wouldn't mind betting a fair few people in this room have watched a whole bunch of stuff about Bitcoin and currency and all that on YouTube. You might have come across Robert Breedlove, who, for whatever stupid reason, has been a bit controversial lately, but I don't give a crap about that. He touches pretty hard. He's got a whole podcast based around the concept or the question of what is money. And I think we're starting to touch on that because fiat currency is a failing form of money and Bitcoin's emerging as a very solid, hard form of money. So I don't know if anyone's got any questions or wants to comment on and try and keep them quick. Otherwise, checkmate, just go for it. But, what is money? This exchange of, human labor to a currency, which then devalues, like that's theft. Inflation is theft. I suppose I'm getting to that topic. Even bloody Rishi Sunak, the British Prime Minister, admitted that inflation is theft in some press conference. I think it was about 6 months ago. Like even the pollies occasionally admit it, and it's all around us. But I don't think enough people are aware. This is one of the big things that Bitcoiners want to try and make people aware of is your work, your wealth is just being eroded, and Bitcoin doesn't do that, and doesn't look like it ever will.
Yeah, so inflation is a very interesting phenomena because the government and the media won't tell you where it comes from because that would be very inconvenient for them. So the problem with inflation is that it taxes everybody. So the correct way that I think to think about inflation is it's a tax, and the governments think it's a tax as well. In fact, the U.S. Fed, there was a paper by this guy, last name Calamiris, last year, which is he's talking about fiscal dominance, which I won't go into. It's a whole different ball game. But what he was basically describing is why, and again, this is by the U.S. central bank, the Fed. What the paper was discussing is why inflation is the preferred tax method by politicians. And the reason it's the preferred tax method by politicians is because most people cannot understand it. They're not taught to understand it. And in our modern economic system, most people who leave university are taught that it's a good thing. So try convincing somebody whose salary depends on inflation occurring that it's actually really bad for everybody and that we should probably not have it. Can't. So, why is inflation such a preferred tax by governments? So, people can't really understand where it comes from. But at the end of the day, it's a result of there being more monetary units. Because if you just imagine, I think Preston Pish had a very good mind game to kind of illustrate this. Imagine that you're playing two games of Monopoly, right? So it's two board games side by side, two players on each board. You're going around, and one of the boards has a rule where every time everyone's gone around, it goes from $200 to $400 to $600 to 800 every time you could pass go, right? So everyone's earning a little bit more money on the right hand side board. The left hand side is still playing the original rules, right? 200. So what do you think happens? Which, if you just play that game for an hour, which board is going to have the most expensive property? I'd hazard a guess it's going to be the one with it's got two. They're up to $1,000 now, right? They've gone around 5 times. They're earning $1,000 every rung. They've got more money to spend, right? So that's Argentina, right? Except instead of 1,000, it's they earn a million every time they go around. So that's literally what inflation looks like. But now imagine you've got this scenario where each turn you can hand over $500 to your mate sitting next to you on the other board. This is foreign investment, right? Suddenly, there's $500 coming in on each guy. What do you think is going to happen to the value of your properties on your board? It's going to go up as well, right? So, inflation is one of these things where when you add more money into the system, if it's a closed system and you don't have more money coming into the system, all of the assets will eventually find their level at the correct price based on their demand because the supply of goods can change and move. The demand of it changes and moves. But if you've also got a third variable of the denominator in like the price of those things is also mobile, you've got 3 degrees of freedom. Is the demand going up? Is the supply going up? Or is the government just printing a whole lot more money? Because you got 3 degrees, it's actually an unsolvable problem, right? When you think about this from like mathematics or engineering, you've only got certain amount of degrees of freedom. If you've got too many of them, you actually can't divulge what is actually happening. So what inflation does is it distorts price signals. So things that are getting more expensive may actually not be because they're highly demanded. It may just be because they're pumping money into the system. The Australian housing market is a great example. People don't know this probably consciously, but subconsciously, the Australian market has become accustomed to buying and selling property because it holds its value. It's not being, it is essentially rising at the rate of inflation. So people buy and trade houses and they escape the dollar because they know the dollar is losing money over time because their bread gets more expensive and their petrol gets more expensive. Everything gets more expensive. So they know not to hold huge sums of cash in the bank. If you go back to, 100 years ago, the classic and again, life was obviously much worse back then, but let's just, apples to apples. The common savings strategy was one third cash, one third gold, one third property. That was kind of like or stocks. That was kind of like the gut feel because you could actually put cash under your mattress and it was gold pegged, so it would actually hold its value. Could you imagine putting cash under your mattress right now? It wouldn't be worth anything by the time you did the washing, right? So this is the problem with inflation is that it taxes everybody. Politicians can very easily be like, look over there, that thing, that's what did it. It was this. But I mean, they printed $4 trillion in 6 weeks. in the US, or in 6 months during COVID. 4 trillion. They doubled the money supply. And we wonder why everything's more expensive. Australia did it, the British did it, the Canadians did it. Everyone just printed a shitload of money. Is anybody really surprised that everything's more expensive? Did you get any of that money? I didn't. Like, I know a bunch of people who would have, and they're pretty much all going to be politicians and bankers, right? These guys got absolutely fat and happy off this stuff because the money is not fairly distributed, but people can't reason about it. They blame it on, oh, it was this, or it was that conflict, or it was that, it was this political issue, my hot button political issue. This is why things are more expensive, right? Whatever it is, it's never, did the government just print a lot of money? Because the answer is they did, but most people don't actually, they can't reason about it, right? We're not taught to reason about these things. So inflation is the preferred tax because people can't understand it. It affects everybody. And unfortunately, the end result of it is people who are better off have less cash exposure and more non cash exposure, assets, houses, gold, stocks, whatever. They see their wealth explode during these times. And the people who are the poorest in society see their wealth collapse because if you don't earn a pay, if inflation is 10%, they tell you it's 5, it's probably 15. If you're not earning 15% wage increase every year, which I strongly doubt many people are, you got a pay cut, right? That's the hard reality. They basically, this is why it's a good tax for them. They give everyone a pay cut. And they know that you can't keep going back to your boss and saying, dude, I need 15%. Like, oh, but inflation says it's 5. It's like, yeah, but bro, we know it's not 5. It's like 15. Imagine having that conversation every single year with your boss. You'd be sacked. Eventually, they're like, I can't deal with this anymore. Or hire someone who's not going to complain as much. That's kind of how the world is structured, unfortunately. And it is why it's the preferred tax. And the final reason why it's preferred, they don't have to do anything. They don't have to like go through a whole election cycle and say, yes, we're going to unfortunately raise the lowest tax bracket from 15 to 25%. No, they don't have to put any new taxes in. They just steal money out of your bank account by making it worth less each time. And that's it. It's a great system if you're them, right? It's not a great system if you're everyone else.
Um, Checkmate. How would you compare or relate, Bitcoin, I suppose, the trading of it and, the price action and all those sorts of things, and potentially, I suppose, the inflation rates of other currencies and cost of capital and all that sort of stuff. How would you relate the way Bitcoin behaves to other currencies or other stocks and equities or even things like gold? I think people can, obviously, I don't think, I know. Obviously, Bitcoin is supposedly this digital gold, and maybe it's going to start behaving that way. And also, I think because your expertise is obviously on-chain analysis, so maybe could you unpack the difference of on-chain analysis and how that relates to TradFi and the way all these assets normally get analyzed? Because on-chain to me seems different. Sorry if that's a massive point.
No, that's good. Yeah, so I mean, Bitcoin is very different, and it goes through different phases where it's correlated to different things. Over the long term, it's uncorrelated, and what uncorrelated means, it's actually very good as a property. What it means is that if gold is rallying, Bitcoin might be selling off. If oil is selling off, Bitcoin might be rallying. But sometimes it's also rallying at the same time as oil. And then sometimes when stocks are selling off, gold's going up. But there's other times when Tesla's going up and Bitcoin's going up. So it swaps around. So when we say it's uncorrelated, if you're in the traditional world, a lot of people have diversified portfolios. The reason why diversification is a thing is because you don't want, well, so it depends who you are, but some people don't want, right? If the stock market is selling off, they want some other part of their portfolio that is specifically selected that when stocks go down, this particular asset usually goes up to kind of offset. So you never blow up where everything sells off at the same time and you just wiped out. So diversification is good. And the fact that Bitcoin is sometimes correlated to gold, sometimes to stocks, sometimes to neither, sometimes it's negatively correlated. It kind of changes, it swaps around, it has its own natural rhythm. And as a result, it doesn't really trade like anything else. It's actually very unique. Again, I came in as an engineer, right? I used to design holes in the ground, right? I used to design everything to do with tunnels and basements and mines and things. But so I don't have a traditional markets background, but there's strangely enough a lot of parallels between the two fields, a lot of probability, a lot of risk, a lot of uncertainty, and a lot of interpolation, right? I've got a few disparate pieces of data and I got to stitch a story together on how the ground got there, or in this case, what Bitcoin is doing and what investors are doing. So in the traditional world, they'll have models for how they value stocks. They'll have models for how they value bonds. There's all these different models for things. Bitcoin, the world has really struggled to value because it has no cash flows. It's kind of like gold, but it's also growing as a network. So it's not really like gold. Gold's kind of like gold's a metal. It's going to be a metal. It's always going to be a metal. There might be more of it, but it's just that's all it is, right? Whereas Bitcoin's kind of not a metal. It's evolving and changing, even though it's not. It's a very interesting dynamic. But as more people adopt this thing, it's going through a growth curve, right? But it's also got these own market cycles. And like, I mean, I don't remember the last time that a derivatives exchange for gold imploded, right? But we have those happen on a regular basis. So there's all these like internal and intrinsic things that happen with Bitcoin. But what I specialized in is a very strange and weird field, and there's not many people who do it. It's called on-chain analysis. And essentially that append-only spreadsheet I was talking about at the start of this call, with all the transactions in it saying, who's sending coins where, there's information in there. So what we do is we basically look at, I mean, not every transaction, but we say like how many transactions happened every day, who sent them, and we categorize things. We use simple things like, people have held their coins for 6 months or more, or people have only just recently bought them, because people who recently bought their coins, they behave differently to people who've been around for 2 years. So when the guys who've held their coins for 2 or 3 years start selling, that's information to me. I want to see that because that's people like myself who've buying in the bear market, waiting for the market to go much higher and then starting to sell. It's kind of useful information. The other thing I want to see is when people who are very inexperienced buy high and then sell low, because people are not very good at trading. So when they buy high, that's usually because they're buying off the smart money who's getting out. And then they usually all sell at the exact wrong time at the bottom. Right. And I released a video the other day that was showing, because it was like 57K. And you can actually see those same people who bought 73,000 thinking that it's going to a million. It didn't go to a million, it went to 57. They sold everything. And they all do this at the same time. Humans behave in this like herd mentality. And it was just the right amount of pain that everybody capitulated. And I made a video about saying, well, this is why I'm like, personally, this is why I'm buying the dip right now, because that's what it looks like. It looks like capitulation. Yes, it could become a bear market, and we'll pay attention to that as it happens. But you can see these like patterns of investor behavior, and they're very, very reliable. And because Bitcoin has all the properties we've talked about, because it's so loved and hated and all the rest of it, it has this very organic signature. The way humans behave with Bitcoin and the way coins move around the system, it's bizarrely structural, and it we can see the price when coins were bought. We can see how long they've been held for. You can't see this for gold. You can't see it for stocks. In fact, you can't see it for any other asset. It's the only one where you've got this kind of clarity. Technically, you can do it for all the other chains, but having experience and tried to do that, all the signatures are all, for want of a better term, they're very ugly and very dirty. The signals inside all those other chains, because you've got like there's an incentive scheme going on, and somebody's minting their own tokens over here, and they're putting them into smart. It's not clean data. Bitcoin is very organic, and I can say that because I'm obviously a Bitcoiner, but having spent time with data on both chains, I can tell you for a fact you got to clean and polish the turd on all the other chains. It's just not the same. Bitcoin, you don't have to do anything. It like the data that comes out of the blockchain itself is remarkably crisp, and it just has human behavior baked into it in a very, very strange way. I don't know how long it's going to have that for. Maybe as the Bitcoin market structure evolves, these signals will change and degrade. People have been telling me that it doesn't work for years, and quite frankly, I don't care for that opinion anymore, because I've spent enough time looking at it that I know it works. I know it'll stop working at some point, but today is not that day. So it really is a fascinating field. It's something that TradFi analysts wish that they had, but it's also something that I think that analysts more and more will start to realize, wow, this is actually, this Bitcoin thing, A, isn't going away. B, we need to have a position on this thing. And C, you're telling me I can see when smart and dumb money are buying and selling coins? Need to start looking at it.
Can I expand on that a little bit, or maybe you can expand? I'll just
Yep.
unpack it. But it's very recent. Like, we're not even. I think we're approaching 4 months since all these ETFs were launched. By the way, you guys are a very quiet bunch. This is the quietest space I've ever hosted. So again, chuck a hand up if you want to ask a question. But yeah, comments or thoughts on the way ETFs might be starting to change trading. Like, we haven't seen the drawdowns of previous cycles. It's 20 to 21% drawdowns for the last year and a half.
Yes. So basically, Bitcoin hasn't, it gave back at 57K recently. That was the deepest correction since FTX blew up. And normal, it was 20.4% we traded down. Usually we get 25, 30, 40, 50, 60% drawdowns regularly in a bull market. So this particular uptrend has been particularly resilient. And I personally don't think it's the ETFs. It was resilient before the ETFs. In fact, you could argue that we had the biggest drawdown after the ETFs came live. So the ETFs, I don't think we've seen this movie many times before. A lot of people think the ETFs are different. In my opinion, they're not. They're exactly the same. They've been there the whole time. And let me explain what I mean. In 2017, what are the ETFs structurally? They are a pool of coins that have a lot of them get sucked in a very short amount of time, and they create some kind of demand influx, right? That's structurally what they are. Well, 2017 saw the emergence of casinos, right? The Binances of the world, the Bitrexes. They were these pools of capital where people would come in. You had to buy Bitcoin to buy shitcoins. So people would buy their Bitcoin and they would trade them into these casinos and use it as kind of the base collateral, the trading pair, right, for all these other coins. So that was a huge demand vector for people to buy Bitcoin in the first place. It was the money that people were using in the casino, right? They were the chips. We saw it in 2019. We talked about that rally in 2019. Most people didn't realize that rally that went from 4K to 14K, there was a Ponzi scheme going on in China that absorbed 2% of the entire Bitcoin supply in like 3 months, called Plus Token. That's a huge spot demand for a bunch of coins in a short period of time. ETF. In 2021, we went from 10K to 64K when Coinbase went live. That period saw GBTC go from I can't remember what they had before, but they absorbed 660,000 Bitcoin in like 4 months, 5 months. ETF, right? We've seen this movie like 4 or 5 times before. So the ETFs are no different to any other supply sink that we've seen. Yes, it's a sign of maturity. Yes, it's growing up. Is it different? Not really. We've seen this movie many times before. The uptrend was already very resilient before the ETFs showed up. So in a way, we haven't had a 20% drawdown since FTX. FTX came a year before the ETFs went live. So this is one of those interesting dynamics where it's very spot driven for sure. 2021 was mostly derivatives and futures and options, and well, not so much options, but definitely futures. We're in a very different regime. We're closer to 2016, actually. We're much closer to 2016 in terms of like an analog. 2016, 2019 are probably my current mental model, somewhere in between those two. Very, very resilient uptrend. It's trading. So there's a couple of different ways that Bitcoin trades. Where we're currently in as a regime that I call quiet and trending, and I released a report on this the other day. Quiet and trending is basically rallies and it goes sideways. It's very boring, but it goes up, then it goes sideways, then it goes up, and then it goes sideways. And if you go and look at the price chart since the FTX low, it goes up, it goes sideways, it goes up, it goes sideways. Extremely healthy. Really, really, that is what you want to see. If you want to see the market go higher, it is going higher. And everyone's like, it's bearish. We're at 68K and everyone's bearish. It's amazing, right? This is what a healthy market looks like. And the other thing about markets like this is it builds support. So when markets go just giga green and just go vertical, there's no support built on those moves. So let's say tomorrow we all wake up and Bitcoin's at 80K US and it's just gone straight there. I will eat my cold card if we don't come back down here to 68, 70 over the course of the next 6 months or so. I almost guarantee that we will fill that. We will kill that candle. That candle will get consumed by red at some point in the future. It's just what happens. If, on the other hand, we wake up tomorrow and it's at 75 and it stays there for a month, then it goes to 78 and it stays there for a month, then it goes to 80. We ain't never coming back. That's what a resilient, strong, robust uptrend looks like. It's super boring, right? It's amazing that boredom is actually a level of pain in markets that people don't expect to experience, especially with Bitcoin. Going sideways, you have no idea how many people bought their coins way back in 2013, 16, 14, whatever, $100, $500, whatever, and they got bored and they sold them. They could have been up 20%. This thing's going nowhere, and they walk away.
Isn't the pizza guy just the classic example of that?
No, the pizza guy was mining. He invented GPU mining. He's got more coins than God. Don't worry about him. He's fine. Um, what I want to know is what happened to the guy who sold the pizzas. What did he do with the 10,000 coins? I bet you any money he doesn't hold them, and he probably sold them for a. I hope he made some money out of it, but I hope it was some decent money.
Yeah, that's a really good point. I commented on one of your posts, or maybe it was someone else's post today, but the Mount Gox saga where the exchange went broke and finally all these poor buggers are getting their money back or their coins back. It's actually probably to their advantage for a lot of them. Like,
Absolutely.
you'd probably say you could back this up better than I can. Heaps of those people probably would have sold out, and they've been forced with no option other than to hodl, and they didn't know whether they'd get it back or not, but now they are. And 10 years on, or whatever it is roughly, epic.
Yep. Now, granted, they took a 85% haircut, but you're right. They were forced hodl. Most people don't hold on to this thing for a long term. So that's the other one. A lot of people have like the critique of, Bitcoin's heavily concentrated and only the whales hold it. Nah, nah. Whale watching is the least productive sport in all of Bitcoin. People love to do it. If you see any analysts who are like, quick, look at this whale wallet, Mr. 100, it's just drivel, it's noise. It's not useful information. It's good for engagement, but it's just not useful. Whales, it's just not the same kind of thing, right? Most people didn't hold on to their supply from all the way back then. In fact, we have a whole cohort of people. Whales, we've actually watched them. Like, you can see them on chain. They buy high and they sell low all the time. They're no better traders than we are, right? So it's just the nature of the beast.
Yeah, cool. Got a couple of people that got some questions. What is it? Sorry, Rico Nakamoto. Question.
I just wanted to compliment Checkmate and just this room. It's good to see this cycle starting off so strong in education and very like humble conversation about this, because you're right, this is a very new asset, and a lot of people coming into this market have never held anything, let alone Bitcoin. It's its own class. And even the SEC and all of their jurisdiction have to change their, the wording, and they're not using the Howey test anymore. So there's a lot of things happening all at once, and it's international. This thing doesn't stop. It's in its own class. So really quick, I think with the previous cycles, and I got in around Gox time. That's when I came in, and my friends now are getting their coins back and they're getting their houses, and it's like this new cycle is going to be very interesting because it's so serious and so much money and caliber and attention is being brought into what Bitcoin's ready for finally. But I just wanted to say, awesome job. Oh yeah, the divergence from previous cycles. I completely agree with you on 2016, 2017 feeling. Its distribution since that massive dump off, which broke previous cycles with the FTX, which really I think it was just more of an attack on Bitcoin to just get this thing at the very bottom to see where we can go. And I think you're right. If we get this massive up candle, you better be right for those massive drop downs. So, just don't FOMO, take your time. We got a lot of time. So yeah, that's it. I just wanted to comment. That's it. I mean, I'm in France and I just appreciate the space. So yeah.
Thanks for that, mate. One thing that you mentioned is that it trades 24/7. Here's a fun fact. I haven't run the numbers for a little while now, but because Bitcoin's a 24-hour market and the stock market is like what, 10 to 4, if you actually look at the trading hours, Bitcoin is as old as if a stock was trading. Last I checked was like 1956. It would be equivalent of a stock that started in 1956 in terms of its maturity. So there's just a fun fact for you.
So right. You're so right. There's a few people that know that.
Yeah.
Absolutely. Yes, it was like 50 years ago, like 5 years ago, and now it's 59. So that's crazy. It's
And from
really
memory,
young.
if we go another like 15 or 16 years, if memory serves, it's going to be older than the Dow Jones, which is like the oldest index in the world. So it's pretty impressive stuff.
Yeah, you said something about how it's natural human nature. It completely trades like Dow theory, which is natural distribution, and especially for something that's so new, you would think it's just chaos. But like if you zoom out and look at previous cycles, the whole meme with three candles in the red,
Yep.
or whatever it is, it's there. It's natural, and we're seeing the beautiful distribution, the steps. You're so right. Like this is the best time to be coming in if you just got in after the crash, because you're in the market of the light. Like you might be in a bull market for the rest of your life. Yeah, you will be. We
Yeah.
all kind of are, right?
Well, and like this is the thing, right? Bitcoin is the biggest it's ever been, right? Or like mathematically, it's just the biggest it's ever been. And simultaneously, it's insignificant relative to the markets it's looking at. It's looking at bonds, which is hundreds of trillions of dollars. So you get gold, which is, I mean, and this is the thing, right? People ask me, I don't do price targets because they're useless. But the one, like the only way you can really come to a price target is by fundamentals, right? People drawing lines on charts, delete them. They're useless. Um, what you can do is be like, well, where does it deserve to go? Where does it belong? And the way that I look at it, so well, is it a 10x better experience than gold? Now, I don't know if any of you have ever bought gold. I have. I've bought it in two methods, and I tried to buy it in one other. I can buy it in my stock account, right, which is fine. But then, okay, it's not really my gold, is it? It's kind of some other guy's gold, and I've got a warrant on it. Now, that particular gold share is one that you can actually go to the Perth Mint and actually get it taken out. So I emailed them and I said, "Hey, look, I've got all these gold shares. Can I actually go and collect my gold?" And they said, "Yes, here's the process. You've got to pay $180 per minting fee. You've got to get them you can't get like the special bars. You can't get them in the gold coins. You have to get them in like the least valuable. Like when you're actually buying and selling physical gold, there's like the coins go for more because they've got like obviously the stamp and they're nice and they're easy to recognize as Australian kangaroo. You get the worst quality of their gold. You got to pay $180 per thing. And I was just like, and I've got to fly to Perth. Okay. Can you mail them to me? It's like, yes, we can mail them to you. And before we do that, we've got to pull them into our vault. Then we're going to charge you a 2% deposit fee. And then we're going to charge you insurance for the time. And you're just like, fuck that. I bought Bitcoin.
And why Perth?
Yeah, I bought Bitcoin instead.
It's like ridiculous. Yeah,
Exactly.
absolutely.
And
Right. Because it's
within
yours.
3 minutes, I had a scarcer asset in my own wallet, like straight off the bat. And the other one, which is actually a good story, I bought one physical ounce way back in the day. And it was very interesting because I went there's a place down in Sydney I went, and I was in there, and I've paid for, I think I paid for it with a card or whatever, and I'm just going to pick it up, got my passport. And this bloke's there, and he's talking to the lady over the counter, and she's counting out his silver and gold coins. I was looking at this bloke like, what the hell is going on here? And then I realized this guy's stacking sats. He's literally there at his monthly, he's talking about the kids and the boat and all the rest of it. He's literally there every month getting his silver coins and his gold coins. I'm like, this guy's stacking sats in the analog version. How strange. And, you hand over your passport, they go out the back, they bring it back, and then you got to you got to walk back to your car and you've got, $3,000 worth of gold in your pocket. And you're like, oh, this is just, I'm sorry, guys. It's just over.
Well, not to mention, there's so many rent seekers. There's so many loops to get to the asset. This is the only asset besides, I mean, the freedom of mind and nature to move and their voice, and even that can be sanctioned at this point. It's the only asset. I mean, it's a piece of the internet. I don't think people realize that we're still in an early stage. I want to just clarify and highlight that we're in an early stage. I think you're right. Eventually that this crazy up and down volatility will start to calm down. We're still We're going to have billions from the bond markets. We're going to have trillions from international, sovereign funds. We'll see what happens, but it's going to get very interesting this next 2 cycles.
And then
all
one
cycles
last thing
after.
on the gold there. I still, so the bar that I bought, that physical bar, it's got its own like little plastic tamper-proof, like thick plastic tamper-proof box with like a barcode and a serial number and shit. So I can't even like open it up to hold the physical gold, because otherwise the verification method that gives it, like, I'll lose $200 just by opening it up, because then they can't verify it's real gold. It could be tungsten for all they know. So I can't even hold the damn thing, right? I've been literally playing in my head. I'm like, do I ever actually want to sell it? I almost want to open it up just to hold the gold, even though I'm going to sacrifice like $250 worth of value. So, with Bitcoin, it's always real, right? I mean, there's other coins out there, but like the Bitcoin network doesn't know about them. So you literally can't receive fake Bitcoin if you're using the Bitcoin network. And that alone, just that verification, it's a 10x improvement.
Beautiful. It's beautiful.
Guys,
it's like a stamp of, it's just,
guys,
yeah.
sorry. Can we go to John? John's had his hand up for a while. I've just brought him back up for a question.
Well, I was just going to add a point on, I had a couple of things, but on the DAO you were mentioning, so that, they obviously, companies come and go over time. I would argue that we're probably getting closer to being the whole time of what the original DAO was set up, because, companies change in and out at times. So really, given the time it's been trading, we're probably closer to a full length of what the original has been around for. And, just the other point, just about the gold and that, I mean, you try and leave Australia or Europe or America with, 20 ounces of gold, you can get pulled up. I mean, if you have a brain wallet in your head, you can just take your BTC anywhere. I mean, it is excellent just because you have purchasing power outside of the system, and you can't be told that you're not allowed to buy something with it because you want to.
Thanks. This is sort of heading towards, I think, some points that Saylor makes about portability and wallets and hot, cold wallets, passphrases. So go for it, guys.
I think the
So
concept
like
of wallets is
yeah.
important because it's everybody has to go through your own journey. And even I've started to realize I'm not at the end of my self-custody journey either. So when you got $100, you start with a hot wallet, but over time you move to a hardware wallet, right? Which is usually where most people stick around. But what I'm starting to get to is, like, over time you realize, like, could my loved ones actually work out my weird and funky self-custody setup? Probably not. So then you got to start thinking about, like, what does the next chapter look like? So custody is it's a whole journey, and it's you don't have to start at the end zone. You actually have to go through that process.
Mate, can we just quickly define hot wallets or software wallets versus cold/hardware wallets for people that are not down this journey as much?
Yes. So the concept of a wallet is a piece of software that talks to the Bitcoin network, and it allows you to spend your coins, essentially, receive and spend. There's different types of wallets. You can get an app on your phone. You can get a piece of software on your desktop. You can get a browser extension. Now, these have varying levels of security. I don't know about you guys, but most people, like, I can't validate my computer, what my computer's doing in the background. Some people can, I can't. Right? I'm a normal human. I don't know what my computer's doing. If your computer is connected to the internet, as most of ours are, you don't know that there's something, you could have a bug, you could have someone in there, who knows, right? Computers are a weird place, and they're complex. Hot wallets are wallets that are connected directly to the internet, and your key, your private key, that really is your Bitcoin. It's kind of like your private key is how you sign your coins. If your private key is in a browser wallet or a phone wallet or a desktop wallet, then it's touching the internet, and you're kind of, you might get an STD if you're not careful, right? So hot wallets are okay for small amounts, right? When you're first getting started, right? If you lose $500, $1,000, okay. It's not fun, but it's also not the end of the world. If you lose 100 grand, you're talking about a whole different animal. So there's things called hardware wallets. And what the hardware wallet is, it's actually a signing device. The coins aren't in the hardware wallet, right? It's not in the computer. But essentially, it's a device that holds your key. and it air gaps between the internet never touches your key. There's a very like a physical barrier that stops the electrical signals from going from the internet into your key. So it's always separated. And there's a whole bunch of these things, but that's essentially the difference between a hot wallet, a wallet that is touching the internet, and you might, if you're not careful, get an STD. And then there's a cold wallet, which is completely disconnected. And as a result, things can still transmit if you're not careful. You can still muck it up and make a mistake, but you're protected from most of the nasties that are out there.
And can we maybe just expand a touch on that whole concept of like the coins don't actually live on your wallet.
Yeah.
Your wallet just gives you the access. The coins are always on the Bitcoin network. As long as you take the right steps, you can move anywhere in the world. You don't even need that hardware wallet necessarily.
Correct. So yeah, essentially your private key, which is usually like 12 words. It's actually like a hexadecimal string, but don't worry about that. It's 12 words. Your 12 words is like your special password. Those words will unlock the ability to move any coins sent to an address owned by that particular wallet. Your wallet, its job is to connect the key to the coin, right? So the Bitcoin network is literally just an append-only ledger. Some of those rows are yours. Your private key allows you to change not the historical rows, but what happens next in their lifespan, right? Each row can be spent and those coins can be moved to somewhere else. You're allowed to append another row to the spreadsheet based on the coins that you already own. That's what your private key does. So you can import that private key into a browser wallet, desktop wallet, and a hardware wallet. If you've put it into your hardware wallet, but you left it on your desktop wallet and your desktop gets hacked, sorry, they're gone. The key is the important part, and the wallet is literally just a vessel to hold and manage the key and allow it to sign transactions to the Bitcoin network.
Question? Go for it.
Hi guys, morning. Can you guys hear me?
Yep.
All right, pleasure to be here. Actually, they have a few questions for, I think it's Checkmate, on his stance as to how he sees Bitcoin. Are you pro? Do you rather people view the protocol just for value acquisition or as a medium of exchange? Or are you of the opinion that one cannot exist without the other?
So this is the store of value or medium of exchange concept.
Yes, and the reason I ask this is because there's a lot of people who now, a lot of newer people in Bitcoin that still do not know whether or not to listen to a lot of people with a ton of Bitcoin. So the narrative is if you've got a shit ton of Bitcoin, you might be viewed as a prophet, for lack of a better word. And then people tend to follow everything you say in tandem. So where do you stand on that? Do you feel that people rather view it as a medium of exchange or a store of value?
I think it's both. It's both, and it will be both for different people at different times and at different times of the cycle and its life. So first things first, just because someone has a lot of Bitcoin, I can assure you, Bitcoin attracts people of all sorts. Not all of them are good, right? The same as anything, but the Bitcoin people with a lot of money tend to get attracted to this thing, and unfortunately, not all of them know what they're talking about. So certainly, having more coins does not mean having more wisdom. That's for damn sure. Bitcoin has to be a store of value. Now, in a journey of a monetary asset, if it wasn't valuable, who cares? Like, I don't want to receive pesos for anything. Well, actually, the Mexican peso is kicking ass, so let's preclude the Mexican peso. I don't particularly want to receive the Venezuelan bolivar for anything because it's not worth anything, right? So because it's not worth anything, it's also a really shitty medium of exchange. But simultaneously, when people get paid in the Venezuelan bolivar, they spend it real quick They use it for a medium of exchange. They do, but they use it to get rid of it. Right? It's like they don't want to hold it because the apple is going to do better than their money. So without store of value, particularly for something like Bitcoin, the Bolivar ain't going to get a foothold here in Australia. It's not going to get a foothold in America because it's worthless. Gold and Bitcoin will. They do. They grow because they're more valuable. Now, if you just go back to that same example with the Bolivar, people in Venezuela will save in the US dollar because the US dollar is to the Bolivar as Bitcoin is to the dollar, right? It is a much sounder, stabler currency. So people will save in the dollar and spend the Bolivar the same way that I will save in Bitcoin and spend my Australian dollars, right? So in a way, currencies are always competing for these use cases. But if you just take that example, I believe the Australian dollar will be worth less over time and the Bitcoin will be worth more. That's why I save in one and spend the other. So in a way, having the dual system is actually very constructive and very productive. That said, Bitcoin and more recently, whenever there's a ticket or someone selling something that I want and they accept Bitcoin, I do a thing called spend and replace, where I spend my Bitcoin that I've just bought, right? Because there's a whole lot of reasons for it, but primarily for tax reasons, it's easier to actually just buy the coin and spend it again, right? So I'm still paying in Bitcoin, but it's off. If they want to accept Bitcoin, then I'll pay them in Bitcoin because it's supporting the network. And for me, that's beneficial, but it's better than spending stacks that you've had for a while, and then you're going to pay taxes on it. But that's a different story. So I think that the medium of exchange is always going to be secondary to the store of value. However, you need both because a monetary asset, I mean, it's no good if Bitcoin didn't move, it's not overly useful. So you still need the transferability of this thing. So both are important. Store of value, I would put more importance on in the early part of its life. Over time, we will have different layers, whether it's Lightning or eCash mints or whatever it is. There'll be a whole lot of technology down the road that helps us spend it better. But for now, store of value is the more important direction. It's why the base layer was designed the way it was, and it's the way it should have been designed. In the long term, there'll be other layers that will help it do the medium of exchange. So you need both, but not at the same time. And each person will have a different experience on those two different axes.
Appreciate the answer. Uh, James, is it okay if I give another question?
Sure, go nuts.
Yeah,
Awesome.
I just want to chime in quickly. We've got a few questions, so this is great. Keep going, guys. Checkmate, I don't know how long you want to hang around for, but I'm a night owl and I can go for quite a while. So let's fucking go.
Yep, go.
All right, awesome. So I appreciate your response. So what's your thoughts on the way the protocol is being the direction the protocol is being driven? And this is piggybacking off the previous question. Are you pro the protocol being designed in a way that you know pushes the case for store of value even more? Or are you pro the design of the protocol be much more for medium of exchange? Because the argument today is per the protocol design, there are proposals that are either intentionally or unintentionally being stifled to move the medium of exchange narrative. Would you disagree with that?
So my
Submission?
general view, and granted, I'm not as deep in terms of like following all of the proposals. Nevertheless, the base layer of Bitcoin, the network, will always be primarily store of value. That's where it will primarily always be, and should be designed to be the best at that. Layers that sit above it are where we should be designing for medium of exchange. And the reason for this, here's another fun fact for you. If all 8 billion people wanted to send a transaction, how long do you reckon it would take? Everyone just wants to send one transaction. That's 8 billion. If everyone wanted to do it, how long would it take the Bitcoin network at full capacity to do that? The answer is 67 years, right? So the problem is there's other chains out there that have been like, well, we can do it in 2 days. And it's like, yeah, but what was the trade-off for that? The trade-off for that is that you've got a CEO in an office and one server. That's the problem. That's the issue. In order to achieve that kind of scalability, you sacrifice all the things that Bitcoin is important for. So, in my opinion, we should be designing the protocol changes that we should be focusing on, in my view, should be ones that improve our capacity to custody Bitcoin. And that's an interesting phrase, because if we're custodying it, well, a Lightning channel is kind of a way to custody it. Having some kind of conditions that allow us to lock it up and unlock it in special ways is a way of custodying the Bitcoin. Having mechanisms that we can lock it into certain other mints or whatever it is, whatever other layer 2 system exists, layer 2, 3, whatever. Having mechanisms that allow us to do that is where a lot of this stuff should be, on the base layer. We will never achieve medium of exchange on the base layer, and it should not be designed for medium of exchange on the base layer. However, we should be designing changes that are very conservative and very well understood on the base layer that enable other layers to do that medium of exchange level. And it's the best framework here. Bitcoin competes with central banks and the dollar itself. It doesn't compete with Visa. It doesn't compete with MasterCard. It doesn't compete with PayPal. Lightning Network and all this other stuff above competes with those things. That's what they have to worry about. Bitcoin competes with the Fed and Fort Knox. That's its job, right? And you don't move gold quickly. You don't move Fed wires quickly, right? They're big, slow moving container ships of value.
Checkmate. Do you want to just quickly compare L1 or layer ones to layer twos? Like Bitcoin's a layer one. Like what is a layer two? Just quickly, I want to go to some more questions. I think BitTown, you were next. You had your hand up, and John again. But do we want to quickly get into that?
Sure. Yeah. So I'll keep it really brief because it's probably a little bit technical. But layer one is basically what the Bitcoin blockchain is. There's a very important framework to remember here. Bitcoin blockchains do not scale. They don't. They're a very, 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 very inefficient and shit database. That's what they are. Why would you ever need a very, very shit inefficient database? Only for one reason. The governments of the world want to stop it. And what's the one thing that they would want to stop? You taking away their printing press. That's the only thing that justifies the level of resilience and robustness that a blockchain requires. Every other use case pales in comparison to that. No one's coming to stop your collectible JPEGs. It's not going to happen.
This is like the way they took gold away, because gold was essentially an L1 when currencies were based on gold.
Correct. And the problem with it is obviously the custody element, right? People deposited their gold at the bank. The banks realized that no one was coming to redeem the gold. So, okay, we've got $100 worth of gold in the bank. Maybe we could lend out 150, right? If no one comes to redeem it. And then they push that envelope too far and they print too much money. And then eventually you get a collapse, right? The whole idea with Bitcoin is you can redeem it immediately. Layer twos, there's very few of them. You could argue Lightning Network is the only one that actually is a layer two, even across all the chains. There's a whole lot of technical definitions, which I admit I'm not across enough to recite off the top of mind. But it's essentially a system that's built on top, right? The same way that the US dollar is kind of the base layer of money, Visa is a company built on top that helps move that money. And they link their network themselves. They link it to all the different payment processes and, card terminals and all that kind of shit. And whilst Lightning Network isn't a company, that's the right way to think about it. It's a system that's built on top that is its own network, but it isn't a blockchain. And the one thing to just if you're kind of still poking around in altcoin worlds, just think about this one concept. If I can convince you that blockchains don't scale, why does every single altcoin build layer twos that are all blockchains? Why are we scaling something that doesn't work with more things that don't work? It makes no sense whatsoever. Lightning Network is not. Now, Lightning Network has its own problems, right? I'm not saying the Lightning is perfect. It's far from perfect. It's got its own problems, but it was a very distinct design decision to not use a blockchain to scale another blockchain, right? Because blockchains don't scale. So why are you using it to scale? Anyway, that's a different topic. But layer twos are basically layers built on top. There's very few of them truly out there, and very few of them are usable. User experience is pretty dog shit for all of them. We're a long way away from it, but we're also very early in the journey. So I'm not too fussed about that at this point.
Thank you, sir. Might touch on a bit of the drama that Saylor caused on development of the core layer 1 versus building on L2. But BitTown, do you still have a question? You had your hand up earlier.
No, I mean, a lot of the points were made. This is an awesome conversation. I guess just to kind of close the cap on that store value versus meaning exchange, the one thing that always pops into my mind is, the monetary metals being gold and silver back in the day. You could have spent gold if you wanted to, but you spent silver primarily over it because that was the one that could be inflated and produced more than anything else, and there was more of it, right? So it's sort of just kind of looking at it like that always helped me sort of understand the store of value versus medium exchange conversation best. So I just wanted to kind of add that in there to kind of cap that part of the conversation. But this is great.
Yeah, I think it's a good comparison, to look through history. That's not a bad comparison, actually. John, what do you got?
So checkmate, you do a lot of charts here. My question about them was, do you use this to try and if you look at a log chart of time in Bitcoin, it's basically going up in a straight line. Are you using it to try and take out your BTC at the tops of those and then buy back into the bottoms like we had at the bottom of November 2022 and eventually increase the amount of Bitcoin you have using this? Or is that your sort of end goal here? Or
my end goal is I like to just explore it. I personally, for me, it's a hobby that became a career. So I just love studying what's going on because I find the way investors behave inside Bitcoin to be just fascinating, and no one else is doing it. So it's kind of a very unique place to be. So for my just transparency, like my personal journey, I kind of found on-chain data back in late 2018. On-chain started in late 2018, really. So I was one of the earliest guys kind of playing around with it, downloading data and putting it into spreadsheets and, sitting there over lunch and just tapping away with seeing what I could produce with it. And I'm basically a DCA hodler. Now I can trade. I have traded in the past. I prefer to trade options. I don't, however. And the reason why is that, I don't know, my net worth is 95% Bitcoin. Depends what price gold is on the day. And despite that, if I've got $100 on a bloody futures position, it consumes 95% of my brain. Even though I'm down $15 or up $20, I don't think about my spot holdings. I never think about them. But if I'm trading leverage, it just consumes too much. I don't enjoy it. I can do it. I'm not bad at it, but I don't like it. It's a level of stress that it's not conducive to me thinking properly. So instead, what I do is I kind of just found this is just how it works for me, right? I prefer to analyze, right? And actually, in most trading firms or trading companies, they will have analysts who do the thinking, and then they have trade executors who actually put the trades on because they're two very distinct.
Quick.
Yep.
John, can you just turn your mic off while you're not speaking? I'm not trying
Sorry.
to, but just getting feedback. Go, checkmate.
So yeah, there's a trade executor and there's a analyst, and the analyst does the thinking. The trader puts the trade on. Sometimes they're the same, sometimes they're not, but that's a very common setup because they're two very different skills. So anyway, I kind of found, in 2019, I blew up a couple of accounts, and as you do, you got to pay your tuition. And what I found is that it's just not for me. I don't enjoy the trading, even though I could do it. I don't enjoy it, but I do enjoy analyzing. So, in terms, for me, Bitcoin is like my forever asset. What am I going to sell it for? The only real thing that I have any, I've been accumulating corn for a while. Like I'll sell a little bit when the time comes to buy a house. I've got some allocated for my kids. That's it. That's kind of as much as I've thought about it. I don't really think about trading it. I build tools that look for tops because some people want to find the top, right? I might scale out some if I want to, put a deposit on a house at that time, yeah, maybe I'll scale some out. I'll use those tools. I definitely use it to buy dips for sure. And I did a video the other day when we sold off to 57 that basically I was, because I've got a Substack, right? So I'm always trying to work out what do people want to read, right? Because obviously they want to read my analysis, but I want to make sure that it's kind of interesting. And I always put a bit of me in the content as well. But I was writing a lot about, is this turning into a bear market up at 73K, right? We've traded down to 57 and things are looking a bit grim. And I've kind of been covering, is it metastasizing into a bear? And my position was not really, probably doesn't look like it. But then we sold down to 57. And I was going through all my own charts and I was like, shit, okay. Well, basically, every single metric that I usually look at is at the point where it's either going to go into a horrific bear market or this is the bottom, right? Because it looks, every single dip looks like this. And this is the thing, right? Here's a really important concept. Markets, you have to hold two views at the same time always. The start of a bear market is the best day of a bull. And the worst day of a bear market is the start of the bull, right? Because the final big red nasty ass candle that everyone goes, fuck, it's over, is the bottom. That's when it stops. That's when it goes up. And the best day of your life, when you've just seen your net worth double in a week, you're probably about to lose a lot of money, right? That's just how markets work. That's just the nature of the beast. So with that as context, I'm looking at all my charts. I'm seeing the price is traded down. Everything is at, there's like a level in on-chain. We call it like a retest level. And the people who are, we call them short-term holders, they're all at the point where it's like, all right, folks, it's make or break. Show us your stones. Actually buy the dip right now. You're either going to buy the dip or we're headed much, much lower. And I made a video on this for my subscribers. I'm like, well, I decided based on all my analysis, it's, this is a dip. It's more likely to be a dip. So I bought a bunch and I was like, maybe I should make a video and actually do a write-up on this and just be like really honest and be like, guys, look, we could go into a bear market tomorrow. So I'm not here to predict the future. I don't know the future. None of us do. Lots of people tell you they know the future. Ignore them. They're wrong. They have no idea. Nobody knows what's going to happen tomorrow. We could go into a bear market tomorrow. What I try to do is go, is that likely? Right. And based on my work, I was like, I don't think so. I think it's more probable that we probably find a bottom down here. So I made a video and a report on it because it was like a useful framework for people to see how I think. And again, I'm not trying to say that it was special, right? It just happened to be a very fortuitous thing that I just put all those puzzle pieces together. I said, it looks like it's probably going to be a dip. If it trades lower than this, we've got all of our signals to say, yeah, look, it was a dip, but now it's something much worse. But that's how I use it. I use it to find better DCA entries. At some point, I'll use it to exit, but for the most part, I design it for other people to, everyone's got their own strategy. Some people, this is their fourth cycle, and it's their time to get out. Right? That's just how it works. Some people, it's their time. Others are going to hodl for another 3 or 4 cycles. Right? Everyone's got a different time preference, and what are you going to spend it on? I was thinking about this actually the other day. I was having a conversation with my old man. And I forget the exact context, but there's this like rule of 3 where, and I was thinking about this a lot. Historically, this is why monarchies fail, by the way. You get somebody who makes a bunch of money, builds a successful business. Their kids take it over and they turn it into an empire. And then the third comes along and pisses it all into the wind. This is a very, very common reality. And I was thinking about that, and I was like, well, okay, if I'm saving my Bitcoin as like a generational wealth, whose generation am I giving it to? Because if I give it to my grandkids, there's a good probability it's going to go on the wall, right? So is it right to think that far ahead? Maybe to an extent, but what I should actually be thinking is like some of that Bitcoin, I should improve my life, right? Not all of it, not even a majority of it, just some of it. And the rest of it I should use to improve my kids' life, give them the upper hand so they can do what they can, right? That's the way I try to think about it. It's it's not even really about me. It's about passing it on, but it's not about passing it on too far. So kind of coming back to the medium of exchange and the store of value, it's going to store my value, but at some point I'm gonna have to spend a decent chunk of it on the rest of my life because otherwise it's going to get pissed against the wall at some point in time. So it's better off like going to a productive use that I'm kind of semi-attached to. To me, that's like a nice way to think about it. Anyway, it's a bit of a rant and a ramble, but that's just how I think about these things.
that 3 generational point was something I was thinking about, because it's like, it's all well and good for us to, eat rice and beans and stack sats, and then you don't use any of it, and then the 3rd generation just pisses it up on Lambos and that, and it's like, well, what was the point in that? Something you might find interesting there. Are you familiar with Raoul Pal?
I am, yes.
With Real Vision? If you saw his video recently, he did an everything code. Towards the end of it, he's doing a sort of a 10-year comparison of all these assets class, REITs, blah, 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 Bitcoin, and everything. Well, the next best performing thing was the NASDAQ 100, and it is down 99.92% compared to BTC. Like, there is nothing better than this. Like, just sitting on this stuff until it becomes $100 trillion asset class is probably the best way that we can all beat inflation here. Like, we can't stop them having a money printer. This is probably as good as it's going to get for us. So yeah, there's volatility, but learn to live it.
Even though on my charts website, which you'll find in my Twitter bio, if you go to my charts website, in the top right, there's a drop-down menu called BTC versus TradFi, and it's got a whole lot of charts that shows like the Sharpe ratio, drawdowns, like all these performance metrics that basically just shows that there's like a big colorful smear down the bottom of all the other shit coins, right? Stocks, bonds, gold, silver, oil, you name it. There's all the other indices down the bottom there, and like they're just like a smear of color down the bottom, and Bitcoin's just trouncing all of them on every single metric. So there's a whole lot of charts, and I've got Australian house prices. It's just like falling to zero over time. So yeah, it's all there, right? So these are performance metrics that hedge funds use. They can't argue with it. Like if you argue with it, you're just wrong, right? These are the numbers.
It's so funny you mentioned the housing market one, because I just opened that and it's just like it's trading up to the right and everything else is going to the bottom. So you can't go wrong here.
Can I jump in on this a touch? I quite like Raoul Pal. I've seen him cop a heap of shit on Twitter, and I think it's at least a little bit unfair. He's very focused on liquidity cycles and like the 4-year cycle, but the 4-year cycle of Bitcoin is conveniently to do with the halving rather than fundamentally to do with the halving, is what he says, because it's all based around election cycles and 4-year cycles of TradFi essentially. Yeah, I'm just curious if you've got much opinion on that. Is that sort of something you resonate with?
If you don't mind me still in the limelight for a sec. So in 10 years, 99% of all BTC will be out in circulation, and then the last of it will be just mining for the next 100 years. And of the next 10 years, that 99% of that will be out. I personally think the whole BTC 4-year halving cycle will have less importance, as you have less of a mining fee per 10-minute blocks. But having said that, the whole row of the 4-year cycle for liquidity, because of all the debt refi cycles and then the elections. So I still think there'd be a cycle like that. But I think given the size of the block rewards, it will reduce over time, and that will be less of an important factor. That's just what I've been picking up.
So can we unpack liquidity and election cycles, because they're a 4-year cycle and it all sort of lined up with the 2008 crisis. But I'm also, checkmate, if we can head this way, what's the longevity of the miners look? Because that's something that people get all, scared about. And, fees going higher is something that people whinge about, and that sort of ties into the layer 1, layer 2 argument or discussion before. And I think these are all converging topics.
Yep. Yeah. So in terms of the mining rewards, obviously halve every 4 years. Now, the one that we just had at roughly these prices, it's about 35 million that came off the market every day. So how big is 35 million? Now, people always give me stick about this, but 35 million is 100 times smaller than the daily trade volume of the ETFs alone, 200 times smaller than the daily spot trade volume, and 1,600 times smaller than futures trade volume. You wouldn't even hear it. You wouldn't even hear it if it hit the market. Now, a lot of people are like, oh, but it's sell side only. It's like, okay, if you put 0.001% of anything into anything, Doesn't matter what direction you put it in the jar from. It's going to disappear. It's gone. So it's so small that it just doesn't matter. So that's the first point, is that the halving already doesn't matter. The second point, in terms of the 4-year cycles, what I will push back on in terms of the guys who are like, oh, it's all about liquidity. It's like, okay, so you're telling me that the libertarians and the cypherpunks back in 2012 were buying it because of, like, they're buying Bitcoin because it's growing and it's interesting and it's new. It has, like, Mount Gox blew up. Oh no, it was a liquidity cycle. It's like, no, Mount Gox blew up. You know what I mean? Like, there's structural elements that also are at play. So it's a very cute thing to be like, oh, it's all liquidity, and it is meaningfully partly about liquidity, but it's not all about liquidity, right? And just the same way, it's not all about mining, but it's also not about mining, right? Back in the early days, the mining was much more significant. So I think this like, it's very easy to be like, oh, it's all this, it's all this. It's always everything, right? It's always gray. There's no black and white. It's always gray. In terms of the miners, this is actually an idea I've been floating around more recently. So people always say, and actually I was trying to contemplate this very interesting fact, that hash rate is always not only at an all-time high, but ripping to new all-time highs at the halving. Why is this? And how can hash rate be at an all-time high? What does that actually mean? So the question we're trying to solve here is, every Ethereum under the sun says Bitcoin's got a security problem. That's why we went to proof of stake. Okay, cute. Let's think about this. Why is hash rate at all-time high on every halving? The only way hash rate can go higher is one of two things is occurring, or both. New rigs are coming online, which means CapEx investment, or new rigs are being researched and developed and then purchased, which is CapEx. Right? You need more efficient, brand new rigs, or more of the existing generation of rigs. That's the only way the hash rate can go higher. In both of those instances, that is a CapEx expenditure. What would a mining industry that was in distress look like? They would only run the machines they've already got. They wouldn't be buying more. They wouldn't be researching more. They wouldn't be creating more hardware, would they? They'd be stressed. They wouldn't have the capital to do that. So mining hash rate being at all-time high actually tells you that Bitcoin doesn't have a security problem at all, because there's been so much capital available that they've got cream on top to keep building new rigs every single year, time and time and time again. So this is like it runs very counter to the halving is, mining rewards are at all-time low per hash. And it's a nasty ass chart, log scale down only, basically never goes up. Mining is the hardest, most competitive, most cutthroat business on planet Earth. I don't think there is a business that is harder to stay alive than Bitcoin mining. Most of the mining companies that are out there today will not be there in 8 years' time. That's I would say that with a high degree of confidence. The vast majority will not be around in 8 years' time. But that's the important part. Hash rate is a global metric. So the global miners continue to buy more hardware and research more hardware. But internally, miners go bankrupt all the time. And this is a really important point. What a lot of people that talk about, all the Ethereans that talk about the security budget, what they don't understand is, well, to be honest, many things about proof of work. But one of the most important things is each miner has a balance sheet and they buy their rigs. Rigs are like a call option and they trade with the price. When the price is ripping, the miner goes up even more, right? And when the price is tanking, the actual piece of hardware, the price of that miner goes down a shitload more than the Bitcoin price, because it is a miners have about like a 4 or 5 year lifespan, right, before they're obsolete. You need to mine as much Bitcoin as you possibly can in that 4 to 5 years. That's the option expiry date. So if you buy a piece of hardware, and the hardware doesn't matter when you buy it, it's when that rig goes out of when there's a new rig that's better than that particular model. So back in 2020, March 2020, Bitcoin's at like 3,000 or 5,000 or whatever it is. S9s, which were unprofitable in the previous cycle, right, worthless, were trading for like $20. Bunch of people bought these things, $20. You got $20 all over the place. And then these rigs, because the price went up so much so quickly, these rigs went back into profit. So suddenly people have got these like fire sale rigs and they're running them and making bloody $100 a day, right? They paid $20 for them and these things are printing money. right now they're worthless. They're completely worthless. Even at the same price at all-time high, worthless today because the new rigs have obsoleted them by such an enormous extent. But this is the important thing. Each miner has their own balance sheet. When did they buy those machines? So even though a miner may go bankrupt, what's going to happen is somebody, either an existing miner or someone with a better balance sheet, is going to come in and buy those machines at a better cost basis at a fire sale. And if they buy those rigs cheap enough, right, the capex component of their expenditure is a huge portion of what miners are exposed to. The value of those rigs is actually a huge part of the mining puzzle. It's not just the coins coming out and the power and all that stuff. The machines themselves are an asset that you have to buy cheap and sell high. So mining is a very competitive business. Internally, miners will go bankrupt all the time, but hash rate is up only. And that means that the security budget doesn't even have close to a problem because there's so much cream that they're still building new damn rigs. When the hash rate goes horizontal, that's when you got a problem. Until the hash rate goes horizontal, there is no security budget problem. Up only.
Is that a good thing? Like if these, reasonably powerful rigs end up in the hands of, solo miners or, just people at home like you and I think probably going to be me soon. This is
this is something, again, I've been playing
going.
with. I don't have a firm view on this, but it's an idea I've been thinking through. So my colleague at Glassnode, he is Iranian descent, and he had a fantastic comment. He goes, the beautiful thing about power is that there's power in Iran, and there's power in Latin America, and there's power in Africa. There's not capital in Africa, and there's not capital in Latin America, right? Capital's in America. So if you think about these consensus mechanisms, proof of work, power is everywhere. So which means that everybody has equal opportunity to it. Proof of stake, it doesn't have the same luxury because the capital is all in one place, right? It's in America. So it's one of these interesting dynamics where proof of work naturally with the power component is distributing. But then if you become these giant mining conglomerate, you've got shareholders, and try convincing those shareholders that you need to, like, the correct thing for a miner to do, in my opinion, if you actually want to be like a, giga huge stoned miner, what you actually want to do is buy your rigs at the bottom of the bear market and sell it all on the way up. You sell the machines as your profit, right? Sell the coins to keep going, but you hold the machines and you get the hell out of all of those machines on the run up. Imagine convincing your shareholders that we're going to sell all of the stuff that you just paid us to buy, and we're going to sit on our ass for 3 years and just wait for the next cycle. Good luck, right? No public company is going to do that, and that's why they're going to go bankrupt, because they don't have that flexibility. Who does have that flexibility? Guys who can just like small scale entrepreneurs who can literally flip these things like burgers and move rigs around, like move their balance sheets, like people who can just come in here and like mine for a bit and then get the hell out. They're going to be way more successful. So in that regard, mining is potentially decentralizing by that token too. Again, it's a bit of just an idea. We'll have to actually see it play out in practice, but I think there's going to be an appreciation moving forward that the rigs are what sends people bankrupt. And as a result, they should actually be traded, and that will make much more volatility in their price. But that would also be a very, very dynamic and interesting component to the mining industry. As I said, cutthroat. Imagine doing this. You can't control the price of power. You can't control the price of the thing that you're mining. Everything is volatile. The governments hate it. It's a hell of a business. I don't know how they do it, but someone will, because the coins are on the table, and if no one's picking them up, someone will go and pick them up.
Thanks. I'll go to Jake in a sec, but just quickly, while we're on this minor topic and the whole cutthroat business, because it is, I have a little bit of understanding on this. Have we seen like a minor capitulation? Like, as far as I know, that kind of happens around about the halving, bit before, bit after, usually a bit after. Has that happened? Because I haven't seen any news around the sort of Twitter sphere or any of that shit about miners capitulating. Do you think that could happen still? Like, is it? Yeah, go on.
No, I mean, we're at all-time high, right? And we've got relatively, not at the moment, but we've had relatively high fees for a while. So, I think mining conditions, it's always going to be tight. But that's why we were talking earlier about like the pure multiple. it's relatively low, so they're not having a fun time, but they're also not getting completely minced. Price goes to 50K, you better believe that miners will be capitulating. That'll absolutely happen. But if we go to 80K, who cares, right? Everyone's happy.
Cool. Cheers. Jake, go. Thanks, mate. You've been patient. And then John after.
Hey guys, how are you?
Good, mate.
Hey, always great to hear you riffing away on how Bitcoin actually functions. I love it. Just one thing I listened to that would be fun to talk through, given I noticed the title is Bitcoin Basics. When it comes to mining, I really didn't understand the significance of Bitcoin until I looked under the hood of what this thing was doing and the amount of computing power that's been curated around the world to actually make the network function. Every 10 minutes, another block is, roughly speaking, put into place. And then the idea that every single transaction that's ever existed is on a small hard drive that we call a node that anyone can have in their home. I mean, it's just extraordinary. But the one thing about picking up stranded energy really is like mind-boggling, right? So when you look at how cities have flourished over the years, often they're on waterways, ports, and they were the kind of connecting points and meeting places for trade to flourish. And so something that I really just found unbelievable was that idea that now you can monetize energy anywhere in the world that previously couldn't make it to market. So whether that was natural gas or crude oil or coal, whatever the case might be, or hydroelectricity, because it was so remote, you couldn't actually get it to enough people at a cheap enough price. But Bitcoin changes that, and Bitcoin mining is part of changing that. So yeah, I don't know if you have any comments on that as a Bitcoin basic. It's not immediately obvious. So all you guys listening in this space, like, don't expect to get this straight away. But essentially, this technology completely turns upside down our traditional energy infrastructure in the quite. It's unbelievable, essentially. So, yeah, checkmate, go for it, brother. I'm sure you've got some.
Can I just jump in?
Please, and James, thanks for letting me in. Appreciate it.
No worries.
Yeah, all good, mate. Checkmate, I reckon probably up to you, but Iris Energy is probably a good example of this and relatable to Aussies. And also the concepts that Saylor talks about with thermodynamics and transfer of energy, like Bitcoin sort of almost acts as a form of energy that you can convert and then convert back as you shift it around the globe. Go on.
Yeah, so I'm not entirely bought in on the digital energy thing. I think it's a buzzword, but I might leave it over there on the altar. What I think is probably the best analog for that is we actually mentioned Iceland earlier in the conversation for God knows what reason, but we did, and they've got a shitload of geothermal energy. Now you cannot run electricity cables, like they've got infinite power over there. Like you can just produce infinite power, but you can't ship it anywhere. Energy needs to be consumed when it's produced, and this is a very unique thing that many people in the greenify the economy area don't seem to understand. Is that right now, if you produce solar power, if you're not using your laptop, that solar power needs to get literally dumped into the earth. It does nothing because no one's using power at that time. So Iceland has a problem. They've got all of this electricity that they can generate for free, completely carbon free, just like it spits out of the ground. It's just springing up all over the place, but they can't do anything with it. So what they ended up doing is they exported that energy using a very, very clever mechanism. They smelt aluminium. So aluminium is extremely energy intensive to actually melt it down and turn it from the ore, from bauxite, into aluminium itself, the metal. So because they have all this free power, it's super easy for them to basically build all these plants, and they export their energy by performing a physical process, right? So that's a great example of an energy source that we've got shitloads of energy. The world is full of it. It's all over the place. Problem is, it's really hard. I mean, like, this is the thing. We may generate stacks and stacks of power from wind turbines offshore, but no one lives next to the wind turbines offshore. That's the problem. The problem is no one lives next to the source of the energy. So we've got all this energy, but what do you do with it? And this is where Bitcoin is actually, I mean, this has got to be the most amazing thing that's happened in the last like 4 years. Bitcoin's done a lot of weird stuff this is by far the weirdest and by far the most amazing, is it's essentially become an almost essential component for the future of energy grids. So energy systems have like a heartbeat, and they have to operate a certain amount of hertz, right? Now, sometimes people have more demand, sometimes they have less demand. Some energy sources, like wind, only turn on when the wind is blowing, and the sun only turns on when the sun's shining. Then you've got other forms like coal and natural gas and nuclear, which are on all the time. So if you think about a heartbeat, you've got this like stable base load, your base load power. And the other thing is, as an engineer, you can't design that nuclear or coal fired power plant for just 100%. You need to design it with extra capacity in case something happens and you need to wind up or down, right? So the power producer has this infrastructure and they've got 130%, but they're only ever running it at 100. That extra 30 is spare buffer zone in case something they need to wind up for whatever reason, right? Population growth or a storm or whatever it is. So they've got this extra capacity, which they're not doing anything with. They could run more power, but they're not. And you've also got this heartbeat where suddenly you've got wind coming in, or then a burst of solar comes in, then the solar turns off. So the heartbeat is like trying to stay stable. And on top of that, you've got all these people turning on laptops, leaving their fridge on. So the fridge is really nicely paired with your coal fired power plant or your nuclear plant because the fridge is always on, the power plant's always turning, right? These two things speak to each other. More intermittent sources can be more useful with other intermittent things, right? You turn on your washing machine during the middle of the day. That's good. You're using the power when it's there. Bitcoin mining can be turned on or off at any time. Now, what's really cool about this, and they're doing this in Texas, and they are the poster child and the model for this whole thing. They've got, I mean, Texas is like a market leader in all these renewables. Plus, they've got nuclear. Plus, they've got a fully like deregulated grid, so it's real market pricing. What the miners do is they will consume any power that's not being used at the cheapest price. They're like, if you got cheap power, we'll consume it. We'll take all of it. Which also means that the power plants can run not at 100%, but at 130 and sell the full capacity. So because they're producing more, selling more of it, they can actually drive prices down. So because there's more buyers and they can operate at full capacity, they can actually earn more money and make everyone's power prices lower. But oh shit, here comes a storm. Or oh no, something happened and the power grid needs extra power. Well, the miners can just go and turn off their rigs instantaneously. And that heartbeat of demand, supply, all of that. The miners are like this buffer zone, this like cloudy thing that just absorbs extra supply over here and gives extra demand back over here. And they wind up and down and actually help the heartbeat of the grid stay stable. And like, it is very, very hard. And to be honest, I've only come to this realization recently. Energy grids have to be, I mean, we've put men on the moon. Energy grids have to be the most incredible thing that humans have ever designed. I don't know how they work. I think the only thing I would give more credibility to is the sewer, because thank fuck for that. But the energy grids we have in the world are astounding. How they stay stable is beyond me. And the fact that Bitcoin mining is going to come in and actually like solve a very, very real and acute and expensive problem, I don't think the world has any idea what this means, but it is the most bullish thing that I have encountered. I mean, I've encountered a lot of shit with Bitcoin that's pretty bullish. This is just like next level gigabrain. And the cool thing about it is that it just happened. It just happened because it made sense, right? It wasn't forced. It wasn't a government subsidy. It just happened because it was a good idea. And that's kind of like, I mean, I was talking to my mate the other day. In my whole time in Bitcoin, right? And this is it's not a too good to be true story, right? I can't think of many things where I'm like, yeah, that's just like a net negative. I truly can't think of anything where it's like, yeah, that's just worse. Bitcoin is just better in every single thing that it touches. It's kind of weird like that. And you know, if you kind of think about what it is, like, you know, it's 1.4 trillion. What did Nvidia added that much market cap since Thursday, right? Like it doesn't make any sense for these companies to be at the valuation of Bitcoin to be this small. If any company was doing the things that Bitcoin is doing just in the energy sector, I mean, you'd be throwing every dollar you had at it because it's the most innovative thing in the world, and it's just a piece of code, it's a piece of software. It's amazing.
Could I add a small side hustle to that? one of the reasons I decided that Bitcoin was very important and to research it further was back in 2018. I was part of a clean tech startup in the UK. It was called Green Alerts. Terrible name. The company failed, didn't work out. But we were looking at trying to supply what's called demand side response to the UK national grid. And we were going to try and do it by behavioral economics. So could we use an app to try and alter people's behavior and turn all their lights off at the same time? And if you could get them to do this en masse, then you could potentially monetize that by selling it to the national grid, because they're always looking for ways to have flexible load. And that business didn't work out, but like Bitcoin's just this crazy thing where you need a series of touch points that help you to see value in it. And that experience made me understand that the grid needed flexibility. The rise of renewables, like it or not, was intermittent energy. And so something to sit in between renewables and baseload power was crucial. And that's kind of what we were trying to solve. But along comes Bitcoin, and I'm suddenly like, hang on a second. The combination of the effects of reducing people's time preference from high to low is a massive, massive behavioral change that improves long-term resource allocation. Plus, the ability to turn your Bitcoin miners on and off is just an extraordinary superpower for modern energy grids, and they couldn't need it at a better time. So, yeah, all that chimes so well. Nice one, James.
Just quickly, I think we're sort of touching checkmate. I don't know what you think on this, but sort of the stuff that Jeff Booth talks about, this deflationary nature of Bitcoin, the way it's just pushing the cost of everything down and down to that marginal cost of production that he talks about a lot. I don't know if you've got many thoughts on that.
Sorry, could you just repeat that last section again?
Jeff Booth's main philosophies where Bitcoin is forcing prices over time to be deflationary and down to the marginal cost of production.
I mean, the Australian house price looks bloody god awful compared to Bitcoin. It's just a hard reality, right? It looks bloody fantastic versus the Australian dollar. It looks shocking versus Bitcoin. So I think that the nature of the beast is that, if we subscribe to what I was talking about before, where Bitcoin is kind of a representation, the volatility of Bitcoin is actually just a reflection of humanity being kind of volatile and kind of wild. In that regard, then, the more that people adopt this thing and the more that people recognize, I mean, that's the other thing. Goldbugs tried for years, decades, to get people to understand that fiat money was bad. Bitcoin did it in 10 years. Fiat money wasn't a word that people used. But now everyone knows what fiat money is, right? People are like, I mean, of course, social media and stuff has a role in this as well, but the Goldbugs couldn't do it. But Bitcoiners did it in very short order. So I think in that way, it's forcing a bit of a reset of people's minds. We've got to be really careful here because, most people don't get it. It takes a long time. I mean, I've dedicated my entire career to this asset, right? How many of my friends do you reckon tell me that it makes no sense? And I'm like, okay, but tell me about your domain expertise. Oh yeah, you're wrong. And they're like, well, hang on, I'm an expert. I'm like, oh yeah, there's your argument. Like, but you can't convince people that this thing makes sense. So it's going to take a long time. I think the thing with Jeff Booth's thesis is it's true and it is the correct framework. But by the time it reaches the state that he's talking about, I think we'll probably be retired or gone is my kind of general framework. It's going to be a long run to get to that point.
I think that's well put actually, because it's a little bit idealistic, or maybe a lot idealistic, but maybe over a long time frame, hopefully. Like that's the whole point of this thing, really, isn't it?
Yeah, and I think that we did go through in 2021 a bit of a what would you call it? A lot of the theories that were talked about and the concepts are all very accurate and clever and smart. They're 100 years away. We'll get there, but they're 100 years away. And I think that the challenge is that human beings are very good at thinking linearly, not good at thinking exponentially, but they're also not very good at thinking logarithmically, right? Which is where we basically go through a period of great expansion and then it plateaus for a long time, right? And then it goes through a period of great expansion, then it plateaus. these are the kind of things that humans aren't very good at thinking about the future. But anyway, that's just, one context there.
Bitcoin Beast, you've had your hand up, and then KC after. Let's go.
Hi there. Yeah, thanks for the opportunity to speak. So, I wanted to ask Checkmate what he thought generally about the Bitcoin proxies, specifically the miners, for retail investors. I'm heavily into them, but I kind of view them as like burning matches that you can't hold through cycles. You just have to get rid of them at the right time. But I think, for me, they have the advantage that you don't have to worry about self-custody so much, and then I hold them in tax-free accounts, and there's also some leverage. So yeah, just wondered what his thoughts were on that.
Yeah, I think the concept of burning matches is a pretty good one. I think they're burning from about 4 different sides. But I think, to be honest, when I think about miners, I think about all of the times that I've lost money with GDX trying to bet on gold miners. And the gold price is at all-time high and GDX still goes down. So it's just one of those things that, like, you've got to be in at the right time at the right place. Most of the time is not the right time and not the right place. I mean, it makes sense in terms of like tax accounts and things, but they are going to be a volatile one and done type investment. So definitely having a finger on the pulse is really important.
You need to be somewhat sophisticated for that sort of stuff, in my view.
Yeah, and like that's the thing. What I don't have is expertise in understanding equities. So even if you ask me to value one of those stocks, I'd probably just look at the price chart and be like, this one did better. That would be about the extent of my analysis.
Yeah, thanks for that. I kind of agree mostly, but I follow Mike Alfred's quite closely because he's pretty good in this space of the miners. But it's definitely something where you need to get out at the right time. But I think if you look on the long enough time scale, they have. I mean, since the bottom, kind of January 23, they've done mostly the top ones have done multiples of what Bitcoin has. So I mean, I think there is opportunity there. But yeah,
Ironically enough, the tool set that I would use, I mean, they're always going to be a levered bet to Bitcoin price. So when, I mean, I would just look at my on-chain indicators. When you see a whole bunch of Bitcoin holders in too much profit and they start taking too much profit, get the hell out, because that's, the miners aren't going to outperform Bitcoin on the downside. So in that instance, just look for when Bitcoin starts to top out, and that would be the extent.
Yeah. Thank you.
KC.
Hey guys, thanks for starting this space. It's just really cool to have a chat and pick everyone's brains, I suppose. Hey, Checkmate. Obviously love your work, so yeah, I just appreciate your time too. Hey, I totally get that we have no crystal ball about, I guess, what happens in the Bitcoin space. But after having chatted about how the Australian real estate market has held up against Bitcoin and all the stuff happening in the macro space, have you picked up on any, say, signs or trends from your on-chain like analytics side that shows which global asset class is most likely to kind of break first to move into Bitcoin? I know it's quite a long-winded question, but I don't know, does that make sense?
So I think the way that I think about on-chain data is, how do I frame this? So if I go back to 2019, I was learning about Bitcoin, spending a lot of time kind of listening to podcasts and starting to understand the monetary plumbing. And, I started to realize, okay, so I think my thesis is they're going to print a bunch of money and they're not going to have much of a choice about that. That was my thesis. And I expressed that thesis by buying Bitcoin, right? So in my very small way, my UTXOs back then, alongside a bunch of other people who listened to the same podcast and had the same aha moment as me, right? All those people were expressing their opinion about the world by their actions with Bitcoin. Some of them said, I'm done. I can't stand this thing anymore. I hate this asset. I'm done. I'm out. I'm selling it. And other people are like, I'm going to keep buying this thing. So over time, you get these like that. So what the on-chain data tells me is, what do people do with respect to Bitcoin? And this is why when I look at a lot of people are like, oh, liquidity did this, or oh, this did that. And it's like, well, yeah, but people were expressing their opinion about that thing slowly, surely, steadily over time through all of its history. So, in that regard, what is inside Bitcoin is kind of how people behaved with and express that view with respect to Bitcoin, right? Now, some people didn't transact on chain. Some people literally just bought it on Coinbase and that was the end of it. But that buy side still pushed the price up a little bit more, which caused somebody else to go, ooh, my triangle's breaking out. It's time for me to buy, right? So, like these things all kind of, it all just is and happens. In terms of the macro, and like, I mean, certainly the on-chain data is not going to tell me that the Japanese yen is going to sell off, but it's telling me, it could tell me that if there's a bunch of people buying, it's like, well, something ain't right. There's a bunch of people in the world. They could be Japanese, maybe they're Korean, maybe they're, who knows? But there's a bunch of people who are buying this thing, and they're holding it for a long time, right? So these are all just the kind of big picture dynamics. But that's what I like about on-chain data is they're long and they're short-term holders. Doesn't matter where they're from. Doesn't matter, what country they're in. It's just you're red or you're blue. You're either long-term holder or you're short-term holder, and that's it. And you kind of just study it. It's like, why do we put them in those buckets? Well, because short-term holders do the same thing. They do the same behavior pattern all the time. Long-term holders do the same pattern all the time. In many ways, you don't need more cohorts than that because that's sufficiently enough to understand what the long-term and the short-term guys are doing. And yeah, that's kind of the way I think about it.
Yeah, awesome. I don't know. I think I've enjoyed seeing the transition from capital to then equity. Like we've had MicroStrategy in the space. You've got MetaPlanet. You now have like Semler that have started holding I guess Treasury Bitcoin, Treasury Reserve. I guess of Bitcoin, I suppose, if I can put it that way. It's just it's following that trend, which just makes it interesting. But as you said, it's always good to fall back on that anchor, or the objective.
It's
What
the
is
truth
it?
of what happened. It's the truth.
Yeah,
It's just
exactly.
reality.
Regardless of who they are, right?
Exactly.
Yeah. No, awesome. Thanks for that.
What do we all think about like the whole MicroStrategy approach, which has just been expanded? That American medical company, I think, dropped a fair chunk on Bitcoin for their capital reserves, and
we'll see how they hold up at the bottom of the bear market. Is my take.
That's exactly what I was thinking.
Good luck to them.
But
not everyone has the same cojones as Mr. Saylor.
Yeah.
So, like,
but it is spreading. I mean, is this good, bad, indifferent, or just inevitable?
It's a bit of all of the above.
My 2 cents on that was he's got to be careful on the sense of recency bias, and this worked for him because we have these cycles. We'll have a blow off, people get euphoric, and then we'll have a come back down to a level. And if he gets stopped out at that, he could screw himself over if he over leverages. So thought was just making sure he doesn't go too over the top. And I did this before. I can just have infinite money glitch. Before, when you mentioned about hash rate, I didn't get my question in time. I got your hash ribbons chart up, and the hash rate is essentially going parabolic from say end of December 2021, and you were saying that was you mentioned that was something that you sort of get towards the top, and I'm like, I just don't see us topping out here. So am I reading your chart wrong?
No.
Or?
I'm not saying that hash rate going up is what I was talking about before with hash rate. When we have a security budget problem, hash rate will go sideways. Yeah. So when the Ethereum's going to start dancing around and say, see, proof of stake is the way, that's when the hash rate's going sideways. Until that point, tell them to sit down.
Okay, gotcha. Sorry, you were saying, do you have I don't want to make this sound like being a lazy shit here, but you mentioned about long-term holders when they are selling, that's probably around the top. Did you have a chart Do you remember the name of a chart that you thought was probably best for capturing
Yeah,
that
absolutely.
data?
There's one on the site called long-term holder binary spending. Basically, what it looks at is when long-term holder supply is declining for 7 days in a row. And it usually will do that for a consistent period of time. So you're basically looking for an extended period of long-term holder sell side. That's kind of the general frame of reference. There's a whole bunch of other shit you can look at, like realized profit and coin day destruction. Because if you think about it, right, when long-term holders are selling, what else are they? What else are you going to see? They're going to take big profits because they probably bought their coins a long time ago, which is probably also at a cheap price, and their coins have been dormant for a long time. So coin day destruction will increase as well. So coin days destroyed is like a volume of holding time that's getting flushed out of the market. So coin days destroyed is another one that you'll start to track. So there's a whole bunch of shit we can look at there, but yeah, I mean, we saw a bunch of their selling into the 73K top, and they pretty much slowed down as we corrected, and they took their boot off, which was good.
Checkmate. Do you want to talk through the basics if people want to start exploring your website? Of just some basic definitions, like some of your favorite indicators. I know you like the MVRV and SOPR and all those sorts of things. Like, just break it down if people want to start exploring, for their first time, maybe.
Yeah. So the first thing I would point you to, and I'm not doing this because I want you to necessarily pay me and sign up, but I am building out a masterclass specifically for this purpose. So part of the content I'm doing is literally from ground zero. Start at ground zero and work out what these things do. And again, I've spent a lot of time with this on-chain data. I released a post the other day, which is about my framework of how I categorize and think about things. And basically, I've divided on-chain metrics into 3 different axes, and different metrics look at different axes. And actually, if you go to my charts website, which is charts.checkonchain.com, there's a green button at the top. And again, forgive me for the navigation. It's a handwritten HTML file by me. It's very primitive, but it does the job. At the top, there's a green button called On-Chain Framework. And you'll see that I've divided the Bitcoin supply into like a cube. And on that cube, there's 3 axes. And every single metric that we look at is, I mean, aside from a hash rate and certain things, but the vast majority of metrics are some measurement along those axes. Are we looking at coins that are moving or not moving? Are we looking at coins by their age, by how many, like whale and shrimp, by exchange or miner, like by entity type? Or are we looking at it by in profit or in loss? And every metric is 1, 2, or 3 of those different axes, right? So many of you may have seen the HODL waves, like a colorful chart that shows the Bitcoin supply broken down by how old it is. That is the coins that are not moving, broken down by age. You can do the same thing by wallet size. Show me how many coins are owned by whales, shrimp, whatever. So that's one way that I like categorize things. And, I've been down many rabbit holes. The whole idea with my charts website is I try to bake the insight. So, I mean, you should be able to go in there and be like, oh, look, it's orange. Now, that doesn't mean that it's the top, but it probably looks like previous tops, right? It's not designed to be perfect because nothing is perfect, but it's designed to be close enough that it should be intuitive to be like, okay, red look bad. That's kind of the framework there. So there's a lot of thinking in there, but the idea is that the charts are free because the data is free. So it makes sense to make the charts free. And I feel like Bitcoin and on-chain's always been open source. But when it comes to actually learning about the metrics, the truth is, like anything, you either need to pay someone to do it for you, or you need to put in the proof of work to learn it. Because like any skill, right? I'm not a good fisherman. And that's not because I don't want to be a good fisherman. It's because I spent bugger all time learning to tie knots and very little time actually fishing because I just never get around to it, right? So until I actually do the work, I'm never going to get very good at it. So I either need to pay someone to go and catch the fish for me, or I need to sit down and actually study this stuff. And the whole purpose of what I'm trying to do at Check on Chain is kind of give people that option, right? You can both in one thing. You can basically pay someone to do it for you and learn. And some people do one, some people do both, some people do neither. It's just that's kind of the way that I tried to structure it out. Anyway, that's enough about that. In terms of the core metrics, that framework, probably without the article, it might be a bit hard to wrap your head around. The most important metric by far is the realized cap. It is the most important metric in all of Bitcoin. The market cap is bullshit. Don't worry about it. It's a completely irrelevant number. The market cap is useless. The realized cap is everything. It is the on-chain market cap. And the reason it's so powerful is it values every coin at the price when it last moved. Now, this is very useful for a number of reasons. One, if you can see the price when every coin was acquired, you can see everyone's cost basis. So you can actually see where like the average cost, the average buy price is. And you can do that for short-term holders, long-term holders, whatever you want. But you can get the average cost basis for people. Now, once you've got the average cost basis for people, the other thing you can do is see when someone who bought low sells high, right? They realize a profit. If someone buys a coin at 10K and sells it at 50, someone else got to come in with $40,000 extra capital. That's capital inflow. So when the realized cap is climbing, that actually means that there's money coming into Bitcoin, right? So it's a capital inflow. Now, some other poor bugger buys the coins at 50K and then capitulates at 20. So he lost 30 grand. He destroys money, destroys capital. That's a capital outflow. So you can use the realized cap to do all sorts of cool stuff. You can model what the real like value of Bitcoin is, about 570 billion as it stands today. You can see when capital is flowing in at what the rate of it is. You can see where everyone's cost basis is. You can see how in profit people are. You can see when they start taking profits. You can see when they start capitulating. These are all the kind of behaviors that tell you that something is happening, right? So the realized cap is the most important metric. First of all, because most other cool metrics are a derivative of it. But second of all, if you wrap your head around that, everything else in the world of on-chain becomes so much more accessible. But you have to get your head around the realized cap. It's probably the most important. It is the most important metric because everything cool is a derivative of it.
Checkmate. I'm just curious. Do you use much of the sort of TradFi stuff of just price charts and RSIs and volume indicators and all that sort of stuff? Like, do you look to that ever? For Confluence or like?
No, not particularly. I mean, I used to, but for the most part, let me assure you of one thing. If price is at the short-term holder cost basis, some traders can be like, this is the very special 61.8 fib. They're always going to be banging about like their 21-day moving average or some shit. It's always like human beings. We're expressing all of our views and it shows up on-chain, TA, fundamentals. Every man and his dog who's like, oh, it's just voodoo. It's like, whatever, dude. You do you, whatever works for you. Like they all tell you the same story. So I don't particularly look at technical. I never look at RSI, for example. I don't look at MACD. I look at the choppiness index. That's I'm not even going to go into it. That's a very strange, weird indicator, but that just works with my process. That's kind of it. Again, I'm not a trader. I am looking at on-chain data as an engineer. I want to see what is happening in the system. And when I understand what's happening in the system, then I can make decisions. It's not so much about this is my buy indicator. It's like, are people selling at the bottom? That's what I'm looking for. I'm not looking for like a particular thing. I'm looking for a behavior. And that's kind of the difference.
Hey, checkmate, just a quick one, if I can chime in. How do you think people should think like an engineer when we're approaching Bitcoin? Because you say you approach it that way.
Yes.
And like, what's one of the things that what's a good starting point, I suppose? Because like, say from my perspective, I studied economics, so I'm wired that way, right? And not long ago, I read your post about just your approach, and yeah, it got me thinking. Like, I need to unlearn certain things to then, I guess, see more of the bigger picture.
Yep.
So that's kind of where I'm coming from. Like, what are we missing that you've gained by being an engineer? If that makes sense.
Yeah, no, absolutely. So strangely enough, I started writing a piece the other day that I didn't scrap. I've put in my drafts folder, and I've just opened it up now. And I'll go through a couple of points because what I was trying to do is, if you can believe it, there's a lot of similarities between being specifically a geotechnical engineer, which is what I used to do, which is everything to do with the ground. So the difference with ground engineers and structural engineers, for example, structural engineers have the wonderful luxury of having empty space that they can put two materials, steel and concrete, that we know we have textbooks written about this shit, and it's always the same. It always does the exact same thing. they have open space and they can put as much of this stuff as they want in wherever they want, right? Yes, there's constraints, but they have to put it where they can put it wherever they want. I get whatever the hell Mother Nature gives me, right? And sometimes it's really ugly. And the other thing that's different about ground engineering is it's already there. I have to move it before I can put anything in the ground, right? So ground engineering is very different in the sense that it's variable. It's if you're going to design a basement, right? It could be 30 meters by 50 meters square, right? And I actually did the numbers here. If you're trying to do that, that's 180 million kilograms of material. And in order to actually design a hole that has to extract 180 million kilograms of material, you're lucky if you get 5 boreholes, and those 5 boreholes are 50 mil. So if you actually work it out, you get 0.00039% of the ground, and you have to design the whole basement, right? So you get 2 pence of nothing, and you've got to think in probabilities. You've got to design based on how did the ground get there. And my first point here is history matters, right? The history of how did the soil and the rock actually get in the position in the first place? Did it used to be a river? Was it a rock? Was it a volcano? Did it have a rock and then it had a volcano over the top of it? Is it like, how did the rock and the soil get there in the first place? And markets are very much the same, because human beings are driven by our historical patterns. I mean, we've been talking about the 4-year cycle. Everyone's looking at the same thing. Why does the 200-day moving average work? Because every man and his dog's like, it's going to be support, man. Like everyone's looking at it. So it is. It's like a self-fulfilling prophecy. So the history of how markets trade is just as important as it is in ground engineering. Learning to think in probabilities, right? So that's like using the borehole and be like, well, sure, I think there's sandstone there, but what happens if there's not? And that's how you have to think, right? You got to, when you're designing and you're thinking about, designing anything, you always have to be flexible enough. And you're like, well, if I design this particular thing and it only works if the sandstone is exactly there, it's probably a shit design, because you're going to get down there and you're like, hey, dude, it's clay. And then you're fucked, right? So you need to think in probabilities and like what could happen. If this happens, I need to have like the flexibility to adapt to it, right? And I mean, markets are 100% about probabilities. So you'll see in a lot of my analysis, whenever I'm talking about the market, you'll always see me say, look, here's what it looks like. This event is happening. This is what this generally means. If we get it to flip over and this doesn't hold, then you start looking for a regime shift, right? You put your bear market goggles on, and you say, well, maybe this isn't just a normal correction. You always have to hold 2 views at the same time. As I was saying earlier on, the start of a bear market is the best day of the bull, and the end of the worst day of the bear is the start of the bull, right? These markets, it's the extreme opposite. You need to hold these 2 views. At the biggest, nastiest, angriest, most disgusting red candle you've ever seen, feels horrible. You should probably buy it, right? That's just kind of the nature of the beast.
As an engineer myself, I just throw my 2 cents in. It's really just problem solving. That's all we engineers do. It's solving problems. So the real essence, I think, to pass on to you there, Casey, is just learning how to solve problems, how to go about solving a problem. Because Checkmate just gave a very excellent overview on the geotechnical stuff. But if I had to sum it up into a sentence, really just how to go about solving a problem.
Yeah, break it down and simplify it, right? A lot of people are looking for like, oh, it has to be this perfect thing, and what's the predictive signal? It's like, let it go. Let go of precision. You don't need precision. You just need to be like, am I seeing? And ask yourself the question: what would you not want to see if you were going to buy this asset? Actually, there's a good quote that I heard on a podcast today. Well, maybe it's like Warren Buffett. It's one of these gurus. The idea is like, you should want to buy this asset that you hold every single day. Now, if you told me that 60% of the long-term holders have exited their position, the market's just absorbed $50 billion in an hour, and the prices rocketed up by 50%, and most of the holders heard about Bitcoin on the news yesterday, would I want to buy that asset? Probably not. Would I want to buy an asset where guys who've been beaten down by a bear market for 2.5 years We're down 85%. The media is telling us we're dead. Bitcoin obituaries had 45 new entries in the last 10 minutes. That is what I want to buy. That's the environment where I want to be in the trenches with those guys, right? That's the way to think about it. Who are you looking for? Who do you want to be in the field with? And if they're not there, you don't want to be there either.
Yeah, no, guys, thanks for that. And I think when I briefly met you at Bitcoin Live, you said this line, Checkmate, that kind of just stuck with me. It's like you can kind of see yourself in the data.
Yep.
And it's just so true, and I guess that's what makes it so valuable. Yeah, guys. Yeah, hey, just to wrap it up from my side, I suppose. Just thanks so much for your work. Keep up the good stuff. And yeah, I guess James briefly mentioned, what your thoughts were about market strategy. My 2 cents on that is just, I just don't know. For Saylor, his conviction is like no other, so we can't really comment on him. But just the other guys coming in, when it gets to the dairy bottom, hairy, scary bear market, I just don't think they know what they're getting into. But yeah, I guess it's the beauty of Bitcoin. By applying economics into this thing, people like convincing themselves of the answers. Yeah, so I guess it'll be interesting to see what happens. But yeah, guys, thanks so much for this.
No worries.
Hey, Check, I'm curious how you look at on-chain in terms of adoption. So besides realized cap, because you hit on that before, are there any metrics you particularly look at, like addresses or transactions, in terms of overall user adoption? What are the best metrics to look at there?
Yeah, there's a bunch of things you can look at. Some of them are a little bit cloudy at the moment because of ordinals and inscriptions. So it's a bit of a nuanced, weird thing, but a lot of the inscription folks, they use these browser wallets that use like it's address reuse. So when we're counting active addresses, for example, we don't double count the same address that was active 50 times in a day. Right now, if that person was using that wallet multiple times and getting into the block because they were spending a high fee, and there's lots of them, what that's basically telling you is that all of those wallets, they're active and they're kind of filling up block space, but we're not double counting them, right? So transaction counts blew out to all-time highs, but active addresses fell off a cliff, and I was like, oh, look, active addresses is down. It's like, no, guys, it's nuanced. So like they're a bit nuanced. They used to be much cleaner, but they're a bit nuanced now. I'll often look at transaction volumes, and I also like to look at what I call Coinday volume or coin block volume. Basically, Coinday's times price. It's like the volume weighted, time weighted value that's moving around the system. That's a nice way to clean up a lot of that shit because it's telling you when old coins in volume are moving. So in terms of adoption, to be honest, I don't really pay that much attention to it because ultimately, if the realized cap is going up, it doesn't really matter who's adopting it because it's capital inflow. In terms of like actual numbers of people, I think that the problem with those kind of estimates, honestly, is the vast majority of people never make it to Bitcoin main chain. Most people end up on Binance and that's as far as they go, or Coinbase, and they stay there. So the numbers of adoption are hard to measure because from memory, there's like 42 million UTXOs, I think, something like that. It's like, and I mean, I don't know about you, but I've got more than one UTXO. So like, it's probably like 10 million people at most, at best, probably less on chain. So it's like there's just not that many people on chain. Most people don't get there. So in terms of like adoption, I don't really pay that much attention to it, to be honest, because generally speaking, it's like the profit and loss and the capital flows is just so much more important. In my view, adoption is when realized cap is going up, and the faster it's going up, the more it's being adopted. And there's an adoption of capital, I think, is the way you'd think about it.
Could you just maybe explain the whole UTXO term to anyone that's not familiar with it?
Yeah, so basically when we say the term a coin, what we actually mean is a UTXO, an unspent transaction output. If you don't know what that is, don't worry about it. The whole point is that each coin is its own like packet of information. And that packet of information says that this coin came from that address, came to this address, and holds this much Bitcoin. The best way to think about a UTXO is when you open up your wallet and you got a $50 note, that's a $50 UTXO. If you got a $20 note, that's a $20 UTXO. If you go and spend that $50 UTXO on $10, you'll get back two $20 notes, two $20 UTXOs. That's your change. That's how they work, more or less. Now, the difference is it's not constrained to 50, 5, 10, 100. It can be any denomination of Bitcoin, right? So the bill can be whatever size you want.
I cannot thank you enough for coming on. This was like full spur of the moment. I only came up with this, I don't know, what was it, 2 or 3 days ago, and a quick couple of DMs, and all of a sudden it was on. Love to do it again sometime, whenever that may be. But yeah, it's been great.
Happy days. No, it's been a pleasure. And thanks everyone for tuning in and all the great questions. Hope you had a good time.